Believe we are live. Can you all hear my audio and see my video properly? Let me know whether am I audible or not, whether am I visible or not. Please let me know. Yes, sir, absolutely audible. Okay. Okay, so hello and welcome to the CA Final Direct Taxes and International Taxation English live power batch applicable for Jan 26 attempt. Very, very warm good morning to all of you present here. Hope you all are doing really, really well. Just let me know how you all are doing so that we can start off with today's session. Meanwhile, let me take you through what we had studied yesterday. So we have with us Harish, we have Neha, we have Bhaskar, we have Kevina, we have Anjana, we have Naresh, and many people joining simultaneously. What we had started yesterday, let me take you through. We started off with tax rates, whereby we started off tax rates under old regime, and we have Vijay with us also. We have started off tax rates under old regime where we understood that any individual HUF, AOP, BOI, artificial juridical person earns any income is taxed at up to 2.5 lakh, no tax, 2.5 lakh to 5 lakh, 5 to 5%, 5 lakh to 10 lakh, 20%, exceeding 10 lakh, 30%. Try repeating after me. If we have any senior citizen who is 60 years of age or more, plus he is resident, then up to 3 lakh no tax, 3 lakh to 5 lakh, 5%, 5 lakh to 10 lakh, 20%, exceeding 10 lakh, 30%. And we have, if we have any super senior citizen who is 80 years of age or more, plus he is resident, then up to 5 lakh no tax, 5 lakh to 10 lakh, 20%, exceeding 10 lakh, it will be 30%. We knew that if somebody celebrates his birthday on 1st April, then he is assumed to have completed the age a day before. Later on, we came on to if any individual HUF, AOP, BOI, artificial juridical person pays tax, then they are levied surcharge also. How much surcharge? It depends upon their income. If their income is up to 50 lakh rupees, no surcharge on tax. If their income exceeds 50 lakh but up to 1 crore, then 10% surcharge. Income exceeds 1 crore but up to 2 crore, then 15% surcharge. Income exceeds 2 crore, then we have to bifurcate the income. Whatever whatever the dividend and cap gain income is, maximum surcharge applicable is 15%, and whatever the other income is, if other income is up to 2 crore, then 15%, if other income exceeds 2 crore up to 5 crore, then 25%, if other income exceeds 5 crore, then 37% surcharge. In all the cases, we have to add 4% education cess. Then we came on to firm local authority LLP. They are levied flat 30% tax, and if their total income exceeds 1 crore, then 12% surcharge is added. Then we came on to companies, where we understood that if we have any kind of foreign company, then it is being taxed at 35%. But if we have any kind of domestic company, we have to check the turnover for previous year 22-23. If turnover exceeds 400 crore, then 30%, otherwise it will be 25%. We understood the surcharge of a company, that if foreign companies total income is up to 1 crore, no surcharge. Total income 1 crore, 10 crore, then 7% surcharge. If total income exceeds 10 crore, then 12% surcharge. Similarly, for foreign company, it is 0, 2, and 5% respectively. Then we came on to cooperative society, which says up to 10,000 no tax, up to 10,000 10%, 10,000 20,000 20%, 20,000 tax will be 30%, and surcharge for a cooperative would be same as surcharge for domestic company 0, 7, and 12. Despite of all these taxes and surcharges, we have to add the education cess. This is what we understood. When we later came on to topic called marginal relief, which said that if somebody's income is increased by a bit, and because of which there is too much increase in tax liability because change in surcharge bracket takes place. So what to do? Government gives marginal relief in this sense. Provision says whatever the tax is being levied on that the surcharge bracket at or on the brink of that surcharge bracket, pay that tax plus surrender whatever the income that you have over and above the surcharge bracket. That will be marginal relief given to you. We understood, and we did questions also on this topic. Later on, we came on to rebate under Section 87A, which said that if we have any individual who is resident, whose total income is up to 5 lakh rupees, he shall be given a rebate under Section 87A of amount equal to 100% of tax payable or 12,500, whichever is lower. But there was a catch. While considering the tax payable, we do not have to take education cess. It has to be gross tax. And second thing, we do not have to take tax of 112A. That means LTCs on listed securities are not to be considered. Rebate on such income is not allowed. Got it, sir? Got it. Then we started off with chapter capital gain. Important, 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 important. We started off with chapter capital gain, where we studied any gain arising from the transfer of the capital asset shall be taxable under that capital gain in the year in which transfer took place. For that matter, we came on to the definition of capital asset, which says any asset is a capital asset, but four things are to be excluded. First of all, stock in trade, plus movable personal assets, plus rural agricultural land, plus gold monetization bonds and gold deposit certificates. These are to be excluded. But jewelry, painting, sculptures, archaeological collection, drawings, any other form of art, bullion are not to be excluded. These will always be capital assets. Then we came on to any securities held by FIIs would also be capital assets. And at last, we understood some portion of ULIP is also capital asset. Then we came on to definition of rural agricultural land, which says any area which is being governed by municipality, municipal corporation, cantonment board is a urban area. Beyond that, it would be rural. But if population is up to 10,000, then that area is only urban. If population exceeds 10,000 up to 1 lakh people, then area beyond municipality 2 kilometer area would also be urban. Beyond that, everything would be rural. And if population exceeds 1 lakh to 10 lakh, then area beyond 6 kilometers of the municipal limits would be urban. And if population exceeds 10 lakh, then area beyond 8 kilometers would be urban, and beyond that, everything would be rural. Then we came on to transfer. Provision says any sale, exchange, relinquishment, any kind of extinguishment in right in an asset, any kind of compulsory acquisition, any kind of conversion, any kind of transferring the possession of immovable property, any kind of transaction which enables you to enjoy the immovable property, or any kind of redemption of zero coupon bond amounts to transfer. Then we came on to period of holding concept, which says if any long-term capital asset is there, then capital gain would be long-term. If we have short-term capital asset, short-term capital gain, then what would be the period of holding to make it? For that matter, there was a date which was relevant, 23rd July. Before that, we had different period of holding, which was any listed securities other than units of business trust to be held for 1 year. Equity oriented mutual funds to be held for 1 year. We had zero coupon bonds to be held for 1 year. We had units of UTI to be held for 1 year. Then we have two other assets like other shares to be held for 2 years. We have immovable property to be held for 2 years, and we have any other assets which were to be held for 3 years to make them long term. But later on, this was subsequently changed, which was listed securities for 1 year. Units were also included in this, and whatever assets we had for 3 year period have been subsumed to 2 year period only. Later on, we came on to computation, where we understood the basic format, sales consideration minus cost of acquisition. This is the basic format of calculating the capital gain. Later on, we came on to how do we compute full value of consideration. We came on to whatever price we are receiving, whatever money we are receiving is to be considered while computing full value of consideration from money receivable and received. But we have full value of consideration in special cases. First of all was 50C. That says if you sell any immovable property, it may be land, it may be building, then you have to check the SDV. If SDV is greater than 110% of consideration, then you have to ignore the consideration just to take the SDV as full value of consideration. But if SDV is lesser than or equal to 110% of consideration, then you have to take the actual consideration as full value of consideration. Sir, what if we are not satisfied with SDV? What to do? Just go to valuation officer. He might increase the SDV, he might decrease the SDV. If he increases, just ignore. If he decreases, then take the lower one. Which SDV to be taken? The date of agreement or date of registration? Provision says the date on which you received money via account, paycheck, demand draft, electronic clearing system is the most important to check which SDV to be taken. Then we came on to if you are selling any unlisted shares, take the FME or sales price, whichever is higher. But this provision is not applicable to the companies whose board of director has been suspended by central government. Then we came on to 50D, which says that if you have unquoted shares, if you are transferring any assets whose sales price is not determinable, just take the FMV of the assets given. But in case you are exchanging, take the FMV of the assets received. This was what we had studied yesterday. Were you able to recall everything? Are Baba, were you able to recall everything? We have Rahul, we have Bijit, we have Kishore, many people joining. Were you able to recall everything? Shall we continue? Yesterday we did first part of the computation portion, which was full value of consideration. Continuing further, we have second part, which is cost of acquisition. We need to understand how cost of acquisition is computed. Let me take you through. Yes, sir, most of the things. Perfect, perfect. Yes, sir, perfect. Now, how do we compute cost of acquisition? Array, sir, it is very simple. Yes, correct, Anjana. Earlier, units were to be held for 3 years to make them long term, but now they are subsumed to 1 year only. What is cost of acquisition? Array, Baba, if I sell a buffalo, whatever price that I had paid to acquire that buffalo would be my cost of acquisition. Yes, that would be that would be cost of acquisition. Whatever price that you pay to acquire the asset. Okay, perfect. Provision says, okay, let me ask you one question. Let me ask you one question to just open up your mind. Let me ask one question to open up your mind. For example, we have with us Anjana. Okay, no offense to anybody, but yes, we have Anjana. Anjana's mother. Anjana, sorry, sorry for this example. Okay. Anjana's mother acquired a property for 50 lakh rupees. Out of this 50 lakh, she used 30 lakh rupees of her self funds, 20 lakh she used loan. Period passed, time passed, time passed, time passed, and her mother did not pay any loan. She did not repay the loan. Now, later on, this property was transferred to Anjana. Her mother gave this property to her. See, since her mother did not pay any loan, bank confiscated this property and asked Anjana to pay 10 lakh rupees of penal amount. Penal amount. Anjana was required to pay 10 lakh rupees of penalty because her mother defaulted in the loan. My question to all of you is whether this 10 lakh rupees should be added to cost or improvement, anything. Should this be added? It is penal amount. I'm saying it is penal amount. Should this be added to cost of acquisition or cost of improvement? Anything. Should this be added or not? Or we should let this go? Kevina says no. Neha says yes. Wow. Wow. Such a divided opinion since morning. I expected to be to I expected you all to be united at morning at least. Bhaskar says no. Anjana says yes. Harish says yes. Yes, Harish. Now let me tell you the answer. Otherwise, we might not be able to complete the session. See, Malishwari says yes. Now let me tell you whether penalty is to be added or not. That is not subject matter of our discussion. Whether it was necessary for Anjana to pay that amount just to obtain the title. That was the important. Provision clearly says if you paid any money to obtain the clear title of the property, that has to be added. If you paid any money to obtain the clear title of the asset, that has to be added. Of course, that has to be added. Always that has to be added. No issue whatsoever. It has to be added. In real life, when you buy a property, na, if you took property on the loan, then people even take deduction of the interest that they have paid. So it is necessary. People even take deduction. People even take deduction of the interest that they have paid over the period. Even take the index cost of acquisition, index cost of improvement as an interest paid. So normally deduction is allowed. Then we have provision says, for example, if you have bought this house, okay. For example, if Anjana bought this house, every year now she paid penal interest. Every year now she pays 2 lakh rupees of EMI. Out of this EMI, if some portion goes to principal and some portion goes to interest. If you are aware, whenever you pay any payment towards the housing loan interest repayment, you are allowed deduction under section 24B. You are allowed deduction under section 80EE or 80EE if you are aware. Otherwise, we will be studying this topic in deduction chapter also. But whenever you pay any interest on housing loan, then you are allowed deduction under two sections. First is 24, that is income from house property, and second thing is section 80EE and EE. You are allowed deduction. Provision says that if you have taken deduction in those sections, now you will not be allowed this interest as cost of acquisition or cost of improvement. Normally, whatever interest on housing loan you pay, you are allowed such expenditure as cost of improvement. But if you have taken deduction of those interests under any other section, you will not be allowed. Similarly, for principal also, people even take deduction of principal under 80C. Provision says if you have taken deduction under 80C, then we will not allow you any such principal as cost of improvement or cost of acquisition. Point clear to everybody? If you have taken deduction of such principal or interest in any of the section, why do we allow it again? Again, it would be twice, it would be two deductions. Na? So whatever principal that you have taken deduction under 80C or whatever interest deduction you have taken under 24B or 80EE or 80EE, those interest and principal we are not going to allow under cost of acquisition or improvement. Remember one thing also, one small thing, whenever you sell any kind of security, whenever you sell any kind of securities, the STT paid is never added to cost. Whatever STT, security transaction tax you paid, it is never added to cost. I will be referring this point again and again later, but right now just remember this. Okay. Now we have certain special cases. What if I have a property? What if I have a property and I gift this property to my sister? For example, I have a property and I gift this sister. I gift this property to my sister. For example, my sister name is Soumya. I have this property and I have gifted this property to my sister. And my sister sold it for 10 crore rupees. Provision says if anybody has acquired property out of exempt transfer, then cost of acquisition for Soumya would not be zero because she has acquired for free, but rather it would be the cost of acquisition of the previous owner. You all are aware that if I acquire property on account of exempt transfer, whatever the cost of acquisition of the previous owner is, that shall be considered. No issue whatsoever. Important point. If any asset is acquired before 1st April 2001, if any asset is acquired before 1st April 2001, then cost of acquisition might be very less. So for that matter, government has given you an option to choose FMV as on 1st April 2001 or purchase price of the SSC, whichever is higher. For example, I had bought a house which was acquired in 1980s. I have a gold ring acquired in 1980s. I have shares of a company acquired in 1980s. Provision says in that case, whatever the fair market value is on 1st April 2001 was, just to take the higher price and take it as your cost of acquisition. We allow you, we give you that option also. Another important point, sir, how do we compute cost of acquisition in case of intangible assets? For example, I have you using Harpic. You know, if you are aware of the Harpic, I have been using Harpic. I have been using corn flour. I have been merging along with some acid. I'll not name this acid, but after merging all of the three, I have devised a tonic, I must say, that helps in diabetes. I mean, by mixing Harpic along with corn flour and by mixing some kind of acid, I have devised a tonic which helps in diabetes. I mean, it even cures the diabetes. I have copyrighted it. I have copyrighted this tonic, or I should say, patented this. Later on, I want to sell this patent. For example, I sold this patent for 5 crore rupees. My simple question to all of you, what would be the cost of acquisition? What would be the cost of acquisition of this patent? You have created a patent. You have created a patent. What would be the cost of acquisition? Provision clearly says. Provision clearly says in this point that if you have any goodwill, trademark, brand name of any business, right to manufacture, produce, process any article, patent or copyright. If you have any right to carry on the business, tenancy right, LUMARs, route permits, or any such intangible assets. Provision says if it is self-generated, take zero. Nil. Yes. Neha says nil. Bhaskar says nil. Anjana says nil. Whatever asset you have which has been self-generated, any asset which is self-generated, take nil as cost of acquisition. Why do we give nil? Because whatever expenses you have done, that will be debited to P&L, that will be allowed as deduction. But right now, we are taking cost of acquisition as nil under capital gain. And if such asset has been purchased, for example, if I have bought a patent for 10 crore rupees and now I am selling at 20 crore rupees, provisions is whatever purchase price that you have paid, just take it as cost of acquisition. This is very simple point. But the best part of the topic is, sir, if you have any self-generated, if you have any intangible asset, FMV as on 1st April 2001 is not available on the other above assets. FMV benefit of 2001 is not applicable to these assets. Why, sir? Why FMV benefit is not available to these assets? Just think of it logically. If you have a gold ring, you can determine the value of gold as on 1st April 2001 so that you are able to identify the FMV. You will be able to identify because gold is very prevalent, it is available in market. If you have a house property, you have SDV as of 1st April 2001. If you have any kind of shares, you can find out the net worth of the shares. You can take the balance sheet. You can calculate the FMV somehow. But how will you be able to compute the value of intangible assets? As on 1st April 2001, even today, intangibles value calculation is difficult part. How will you be able to calculate on 1st April? So for that matter, provision says FMV benefit as on 1st April 2001 is not available to intangible assets. If you have any patent acquired 1980s, FMV benefit will not be available on those assets. Also says, okay. Now, another important point. For example, if I have a plant and machinery acquired for 10 lakh, depreciated value 5 lakh, sold for 12 lakh. What would be the cost of acquisition of this plant and machinery? Try answering it as fast as you can. If I have a plant and machinery sold for 12 lakh rupees, I had acquired that plant and machinery for 10 lakh, but WDV is 5 lakh. What would be the cost of acquisition of this plant and machinery? You answer me. If I have a plant and machinery acquired for 10 lakh, but depreciated value is 5 lakh, I am selling it for 12 lakh. What would be the cost of acquisition of this plant and machinery? What would be the actual cost of acquisition for the purpose of capital gain computation? Bhaskar says 5 lakh. Bhaskar says 5 lakh. Devana says 5 lakh. And no extra points for guessing. See, I'm again briefing out what I am telling. Normally, whenever you pay any price for an asset, that is the cost of acquisition. Whatever price you pay to acquire the asset is the cost of acquisition of that asset. But these are special cases. Here, whatever price you paid is not the cost of acquisition. Here, the WTP is cost of acquisition. For intangible assets, if you have self-generated, the cost of acquisition would be zero. If it is an exempt transfer, you acquired that asset on account of exempt transfer, then whatever the cost of acquisition is of the previous owner would be your cost of acquisition. These are special cases for determining cost of acquisition. Okay, perfect. Perfect. Another beautiful question. Now let me ask everybody. Let me ask everybody. For example, we have with us Bhaskar. Bhaskar worked really hard. Bhaskar really worked hard. He became chartered accountant. He got a job at Reliance. Let us assume he got a job at Reliance. As soon as he joined, Mukesh Ambani, just after looking at his face, announced, "Such a beautiful, charming boy he is. I want to give you ESOPs." Bhaskar has been awarded ESOPs just after joining, just because of the charming face he has. He has been given ESOPs. How ESOPs he has been given? He has been given 10,000 shares of Reliance at rupees 500 each. Whereas Market value of the share is 1,000 rupees. Oh my god. Oh my god. Market value is 1,000 and he has been awarded three shares at 500 rupees. Wow. Later on, Bhaskar exercised these ESOPs. Bought these shares at 500 only. Now he is feeling some kind of crash crunch. Therefore, he sold these assets, sold these shares. Let us assume these shares have been sold for 1200 each. So full value of consideration would be 1200. Of course, since these assets are being sold at 1200, full value of consideration would be 1200. My question to all of you, what would be the cost of acquisition? Would it be 500 or would it be 1000 or would it be something else? Hmm. Question is great. See how you are able to identify this point. Kevina, 500. Bhaskar. FME on next date, market value asset, 1000. Kevina says this thing. Okay. Bhaskar says 500. Harish, Neha, Bijit, Kishore. Whereas we have two people, Malishwari, 1000. And somebody else also said 1000. Wow. Kishore, did you answer two things? Okay, Kishore said 500. Okay. And we have Anjana saying 1000. Now, who is the real winner in this answer? Who is the real winner? It shall be 500. It shall be 1000. And with that, welcome to CA final. Cost of acquisition for the ESOP shares are always FMV as on the date of the acquisition. Why, sir? Why? How? I feel floor is, slipping away my legs. Slipping away from my legs. Why did this happen? Let me tell you simple reason. If shares are trading at market value of these shares are 1,000 rupees and we are given these shares at 500 rupees only. ESOP prices 1,500 rupees only. Shares were trading at 1,000. We are given 500. I paid only 500 rupees. But issue here is this 500, the difference is already taxable under head salary. Because this benefit is on account of employee-employee relationship now. An employee-employee relationship is taxable under salary head. Are you getting this point? Are you getting this point? That employee-employee relationship between the two is taxable under that salary. So this 500 is already taxable. And if you do 500 as cost of acquisition, you would be indirectly taxing 700 as capital gain. And this would be wrong because 500 has already been taxed under the head salary now. Therefore, it would be 1,000. Are you getting this point? Yes, understood now, sir. Got it. Perfect. Beautiful. FMB and on the date on which option is exercised is the cost of acquisition for ESOP shares. I hope you got the point. We have now bonus shares. Bonus. See, bonus is very simple. Bonus is very simple. What bonus says? If bonus, well, normally bonus is nil. Whenever you get bonus now, it is nil. Normally bonus is nil. But if bonus has been allotted before 1st April 2001, then take the FMV as on 1st April 2001. Whatever the FMV as on 1st April 2001 is, just take that as cost of acquisition. But if bonus has been allotted after 1st April 2001, then normally it is nil. If these shares are listed shares, then you are given benefit of 31st Jan 2018. That means grandfathering effect that you study now. That is given on bonus shares. So what I did just say, if bonus is allotted to you, bonus shares are allotted to you. Normally, bonus shares are considered as zero as cost of acquisition. Zero is considered as cost of acquisition for bonus. But but if these bonus have been acquired prior to 1st April 2001, then FME benefit, as I said, it is available. FME benefit is available on the assets. Similarly for bonus also. If allotted after 1st April 2001, then you are given benefit under section 112A as cost of acquisition on listed bonus shares. Otherwise, it is always nil. Otherwise, it is always nil. Sir, cost of acquisition for right shares. For example, a share is trading at rupees 1000 and I am given a right to buy this share at 800. And I actually bought this share. So what would be my cost of acquisition? Arey Baba, if I am paying 800 to company, so 800 would only be cost of acquisition. No? If I am acquire any share on an right issue, provision says whatever price I am paying to the company would be my cost of acquisition. But sir, what happens? What if I do not want to buy this share at 800? I am renouncing this share. I am renouncing this share for 50 rupees to somebody else, for example, to Neha. I am renouncing this share to Neha. Okay. Now, since I am getting 50 rupees at free of cost, now this would be short-term capital gain to me. This would be short-term capital gain to me. And for Neha, cost of acquisition would be, since she paid 800 to company and 50 rupees to Rahul, her cost of acquisition would be 850. So are we clear with the fact how do we calculate the cost of acquisition in case of right shares? If I am having a right and I exercise that right, if I have a right and if I exercise that right, whatever I pay to the company, that would be my cost of acquisition. But if I do not exercise that right, I renounce it. Whatever renouncement money I am receiving, that would be my short-term capital gain. Second thing, if person who is buying these renounced share, for him cost of acquisition would be price paid to company plus price paid to for renouncement, that would be cost of acquisition. Very simple. That means whatever money we are paying to acquire those share would be actual cost of acquisition. Now question of the hour. For example, this is Reliance share. Listed, okay, of course, Reliance is listed. Reliance is trading at rupees 1000 and I am given a right to acquire this Reliance share at 800. Perfect. And I renounced this right. I renounced I renounced this right at rupees 50. This 50 would be short-term capital gain, as everybody said. Just asking for reference, what would be the tax rate applicable? What would be tax rate applicable to this short-term capital gain? Cost of acquisition zero, Anjana. Cost of acquisition would be zero. Devina, what would be your capital gain in this case? Amount full 50 rupees would be capital gain, short-term capital gain. What would be the tax rate applicable to this STCG? Beautiful question it is. What Whenever we renounce any rights, we earn short-term capital gain. Whatever renouncement money we receive is the absolute amount taxable under capital gain. Cost of acquisition for this renouncement price is zero. Even I says 20%. Considering it after 23rd July. Okay, noted. Malishwari says 20%. Vijit on the contrary says no sir, it will be taxed at slab. Or he is questioning this thing. Sir, should it be taxed at slab? He's thinking this way. What other people are thinking? What other people have opinion? What opinion other people have? Everybody is thinking like, sir, we don't want to answer. Every time when we answer, you cross us through. Kevin says, uh, no slab rate. Okay. Okay. I mean, she's sticking to 20% tax rate. What other people want to say? No opinion. Don't want to give any opinion. Achha, somebody said, Anjana said 15-20. Okay. Anjana Neha 15-20. Okay. Anjana also said 20%. Neha also said 20%. Listed and STCG. Wow. Everybody said. Anybody else who want to answer this question? Let me tell you. Harish. Done with answering? Welcome to CA final again. It is not the share you are selling, it is the right that you are selling, and rights are not covered under section 112A or 11111A. Remember, I have not taught this section, therefore it is possible that you are saying this wrong. But if you are saying 20%, that means you are assuming that these shares are covered under section 111A. When section 111A exclusively says, section 111 exclusively says this thing, that any shares on which STT has been paid at the time of acquisition and sale is considered under 111A. If you are just selling the rights, are you paying any STT? It is not even a share that is being sold. It is just a right that is being sold. So it will be a normal STCG and it will be taxed at the rate of slab. Just tell me, were you aware about this fact or not? Every day, I really enjoy when everybody says the wrong thing because it actually gives this batch a value. These things actually give this batch a value. I hope you got the point. Hmm. Okay, perfect. Last thing, shares in case of demerger. Not aware. No issue, no issue. See, this batch is meant for that thing only. Na? If you are not aware of anything, I am there to make you aware. And this is not what I am saying out of nowhere. I have this experience also, and I have studied this thing, and there are multiple court judgment also which tax these things at slab rate only. And logically, it is correct. Logically, it is correct because section 111 20% is applicable only to those assets on which you have paid STT, and on these shares you have not paid STT. 50 rupees that you got is not you have not paid STT on this. This is just an outside circulation of the rights, so it is not taxable under 111. Now, last thing, just logically, I want you all to answer. Just logically, just with pure logic, I want to answer. Just pure logic. Huh? We have a company called Reliance, whose net assets are 1,000 crore. Assuming, okay, 1,000 crore net assets Reliance has. How? And Reliance is trading at rupees 1,500. Reliance is trading at 1,500. Out of this 1,000 crore, company got demerged called Geo Financial Services. Reliance had net assets of rupees 1,000 crore. Out of this 1,000 crore, 100 crore assets have been taken by Geo Financial Services. Now Reliance is left with only 900 crore worth of assets. That means 10% of the assets have been taken by Geo Financial Services. Okay, perfect. Earlier Reliance was trading at 1,500 rupees. Now, what would be the price of Reliance share? Price of Reliance share. A basic common sense question I'm asking. Earlier Reliance had net assets of 1,000 crore and 100 crore have been taken by the Geo. Earlier Reliance was trading at 1,500 rupees. What would happen to share price after this demerger? Just with logic, I want you all to answer. Earlier 1,000 crore, now 10% has been reduced. Net 10% net assets have been reduced. What would happen to share price theoretically? Just logically, I want you all to answer. Just logically. Shubham Walia said, can we get the PDF of this concept book also? Shubham, I'm not allowed to share. Honestly, I'm not allowed to share. I wish I could, but I'm not allowed. It's institute policy. We cannot share this PDF. And the second thing, if you don't have, I am saying that just you can write it out, write it down. Malishwari says, Bhaskar says, Neha says 1350. 1350. Kevana says, Neha says, Anjana says, everybody proportionately. This is the common sense that everybody is applying. Am I making you learn any formula? See, if 10% net assets have been gone to Geo Financial Services, theoretically 10% share price would also fall. And what would happen to 10% of the share price? 150 would become share price of Geo Financial Services. Oh my God. Oh my God. And this is what happens in case of demerger. For example, I had a share of Reliance. I had a share of Reliance. And Reliance undergone demerger. Okay. So now the share price of Reliance would fall to 100, 1350 because some of the net assets have been taken away by Geo Financial Services. Similarly, whatever the proportion of net assets have been taken away by Geo Financial Services, my share price is going to fall accordingly. Therefore, my share price is 10% fall, and whatever the fall that has taken place would be the cost of acquisition for the demerged or for the resulting company, for the Geo Financial Services. Now, if I ought to sell this Geo Financial Services shares, if I sell it for 300, my cost of acquisition would not be zero, rather it would be 150. Are you getting this point? See, we do have a formula for this. We do have a formula for this. For example, cost of acquisition in case of demerger. Share price held in demerged company, that is Reliance, 1500. Net book value of assets transfer 100. Net book value of assets before demerger 1000. This will give us 150. This is what the formula also teaches us. But do we need to learn this formula? Isn't it very clear that the proportion of net assets would give you the share price of the resulting company? Share price of the original company in the proportion of the net assets transferred would give you share price of the new company. Isn't this very logical? Everybody answered this point that 1350 would be share price of the Reliance and 150 would be share price of the Geo. It is very logical. You don't need to fall into any formula. Okay. Everybody clear? Everybody clear with this point? One thing I want to ask. One question I want to ask. Just listen this point carefully. And again, briefing out what did I just say? Reliance had net assets of rupees 1000 crore. Geo Financial Services took away 10% of the net assets. Earlier, Reliance was trading for 1500 crore, 1500 rupees. Now, what was the ratio? Rahul, who had one share of Reliance, was given 3 shares of Geo Financial Services. What would be cost of acquisition for Geo Financial Services? Now answer this question. Now answer this question. What I am saying is just try to understand. Earlier, Reliance was trading at 1500. 10% have been taken taken by Geo Financial Services. But here ratio is not simple. For one share of Reliance, I got 3 shares of Geo. So for me, whether Geo price would be 150, that's correct. That's incorrect. That's incorrect. Share price would either fall or it would increase. That's what I want you all to answer. If I'm asked to write the facts of the case, net assets of Reliance 1000 crore taken by Geo. Let me 900 after demerger. Net assets with Geo Financial Services 100 crore. Earlier, Reliance was trading at 1500 and demerger ratio 1 for every 3 held. Sorry, 3 for every 1 held. What would happen to share price of Geo Financial Services? Let me tell you. If this ratio would have been 1:1, then share price of Geo would have been 150. Everybody calculated this thing. No, I guess I am not able to portray this thing properly, but okay. If this ratio would have been 1:1, if this ratio would have been 1:1, then share price of Geo would have been 150. Everybody would agree with this. if this ratio would have been 1 is to 1. For every one share of Reliance, I am getting one share of Jio. So 10% would have been my share price, therefore 150 would have been right answer. But against one share of Reliance, I am getting three shares now. I am getting three shares now. So should I be dividing 3 or should I be multiplying 3? Sir, net assets remain the same now. And if share prices in number of shares are increasing, so value of each share would reduce. So for that matter, we have to divide, and 50 rupees would be share price of the Geo Financial Services. If 1 is to 3, number of shares are increasing now, so in that case what would happen? 50 would be right answer, as Bhaskar said, not 450. Why not multiplying? Why not dividing? Basic logic, basic mathematics, that if net assets are same and number of shares if we are increasing, then what would happen? Maleshwari, 1350 divided by 3. Why 1350 divided by 3? Okay, Kevana says 1350. Okay. See, what I mean to say is I am ignoring the shares of Reliance. I'm not considering. My point of matter is not Reliance. My point of matter is Geo. The resulting company share price has to be determined by me. If resulting company is getting 10% of the net assets, then 10% share price would come to this company. I'm telling. Okay. I'm again referring to this point. This point always takes this time. See, Ranjana, try understanding this, huh? This is the basket of all the net assets of Reliance. And share, okay, this basket is of 1,000 crore. And each share of Reliance trades at rupees 1,500. Kevna, let me explain this once again. If you have any doubt, then just tell. Reliance is being traded at 1,000 and each share price is at 1,500. Now, out of this 10% is cut and a new company is formed, Geo Financial Services. Correct? This company has net assets of 100 crore. And now Reliance is only left with 900 crore. Don't you think that share price, which was 1,500, it will fall by 10% because 10% net assets have been wiped away? Don't you think 10% share price would fall because 10% of net assets have been gone? Share price would be 1,350. And whatever net assets have been gone to Geo Financial Services would determine the share price. So for every share of Geo would be 150. Anybody having any doubt up to this point? But if 10% net assets went to Geo Financial Services, 10% of share price would also go. Anybody having any doubt up to this point? Anybody having any doubt up to this point? No doubt. No. But this is what you are saying when ratio is 1 to 1. Na. If I had one share of Reliance and I got one share of Geo, I had one share of Reliance and I got one share of Geo, then share price of Geo would be 150, of course. But if for one share of Reliance I got three shares of Geo, why would share price be the 150 only? 150 would be share price. The number of assets I had would be 1350. Plus, if 150 would be price and multiplied by 3, then 450 would become assets. And out of demerger only I earned and I got the value of 1800. This would be wrong now. So share price has to be 150 divided by 3. That means 50 would be share price. And this would solve the equation. 3 shares of 50. That means value is 150. And 1350 is the share price of these Reliance. This would collectively make 1500 only. Are you understanding why did we divide with the number of shares that we got? If we did not divide, if we just multiply, then what would happen? Then our share price, our total value would be 1800, and it is incorrect. It is just a theoretical adjustment. Demerger is a theoretical adjustment. Are you getting this point? Anybody now? Anybody having any doubt? Perfect. Understood. Perfect. This was cost of acquisition in special cases. Now I have a special point to make. So all everybody focus here now. Everybody focus here for a minute now. Second proviso to section 48. What does it talk about? It talks about cost of acquisition to be indexed, oblique cost of improvement to be indexed. But only if transfer took place before 23rd July 2024. Perfect. What does this point says? Second proviso section 48 explicitly says that whenever you are considering cost of acquisition of an asset, you just have to do the indexation portion. What does that indexation means? Dividing by, for example, if I have a house acquired on 1st April 2001 and selling it in 2024-25. That means in that year CII would have been 100, and right now we have CII 363. So cost of acquisition would be 3630. That means we are just inflating the price based on the inflation index. We are aware of this indexation. I am not getting into depth of this indexation right now. What my issue is? What my issue is, sir, what if house has been acquired prior to 1st April 2001? See, index numbers are available with us from 1st April for 20 of 0102. Previous year, financial year 0102, we have index number. What if house was acquired prior to that? Then what to do? Provision says if any house has been acquired prior to 1st April 2001, then just take the FMV. We have already discussed FMV on 1st April 2001 or actual cost, whichever is higher, and then do the indexation portion. People would try to manipulate this FMV as on 1st April 2001. So provision also said that if you have SDV, if you have stamp duty value available of the property on 1st April 2001, then maximum FMV can be SDV, stamp duty value. But if SDV is not available, then FMV shall be okay. Whatever FMV you are deriving is okay. Basic fundamental of indexation, that if any asset has been acquired previously, if you have any long-term capital asset, cost of acquisition would be indexed, cost of improvement would be indexed. How indexation would be done? We would be dividing by the CII of year of acquisition, multiplying by CII of year of transfer. This would give us cost of equity. This would give us index cost of acquisition. This will also give us index cost of improvement. If any asset has been acquired prior to 1st April 2001, then take the FMV or actual cost, whichever is higher, and do indexation accordingly. In case of immovable property, the stamp duty value is available, then remember your FMV cannot exceed SDV. Maximum FMV that is allowed is stamp duty value, because people would try to manipulate the FMV, increase the cost of acquisition and reduce the capital gain. Therefore, maximum FMV allowed is stamp duty value. And if SDV is not available of that property, then whatever FMV you're deriving, it is okay. These are the basic things. See, these were the basic things about indexation, but let me tell you what changed. Up to 23rd July 2024, indexation was allowed on almost all assets, almost all long-term assets. Almost all long-term assets. It was still not allowed on certain assets. Let me quote it to you. Listed securities, it was not allowed. It was not allowed on bonds and debentures. It was not allowed on 50 AA securities. It was not allowed on uh, some sale. It was not allowed on first proviso. It was not allowed on certain more cases. I will refer to that again. Indexation was normally allowed on all the assets. It was allowed on gold. It was allowed on gold. It was allowed on buildings. It was allowed on shares also, unlisted ones. It was allowed in sovereign gold bonds, etc. It was allowed on these assets. To 22nd July. With effect from 23rd July. Government made this mandate. No indexation at all. No indexation at all. Whatever cost of acquisition you have would be only considered. Whatever cost of acquisition you have, that will only be considered. No indexation whatsoever. Sir, but we are aware that in immovable property, individual HUF are allowed. Arey Baba, I'm saying that is not allowed. Whatever that you have studied is tax calculation. Right now, while computing the capital gain, no indexation is allowed. Right now, we are understanding computation of capital gain, and at the time of computation, no indexation is allowed. And literally, I mean it, no indexation. Earlier, you were allowed indexation on almost all the securities except for these five or six, but right now, no indexation at all. Anybody having any issue in this point? I'm not yet done, but still, anybody have any issue at this point? Anybody having any issue to this point? That means, again, this date is very important for you. 23rd July is important for you. If transfer took place before 23rd July, then period of holding concepts are different. You are allowed indexation. Your tax rate would be old. But sir, if transfer took place after 23rd July, then period of holding concepts are different. No indexation on cost of acquisition, no indexation on improvement, not nothing. And the tax rate would also change. So date of transfer is very, very, very important for every question that you solve in capital gain. Very important question, very important point. Date of transfer has to be first checked. And it is not possible that examiner would not mention date of transfer. It would mention for sure 110% it is going to mention. You have to check date of transfer and then follow the laws accordingly. Are you clear with that point? This point I am putting on hold. Okay, hold right now. Because I personally think unless we discuss tax rates, it would not make much sense to discuss more of these points. I will be telling when I will be teaching tax rates for capital gain, I would be more deep talking about this point. Right now, it is sufficient that we know this much. Sir, first proviso to section 48. Indexation isn't the point that is much tested in CA final exam, so need not to worry. You are already aware about indexation. You just have to divide by CIA of year of acquisition, multiply by CIA of year of transfer. If transfer took place before 31st July, 23rd July 2024. First proviso to section 48. This is the area of focus that has not been asked. From many attempts, this has not been asked. Once, I guess it was asked in MCQs 2 or 3 years late ago. Right now, it has not been asked. That too in MCQs of RTP, it was asked. This is an important point, and let me tell you how. What this proviso says. For example, we have Mr. Joy Rebiani. We have Joy Trebiani. He had a vision that India is going to grow a lot. He had a vision that India is going to grow enormously. So he invested in shares of Rahul Limited, or I should say Rahul Private Limited. He had vision in India. So he invested in me. How much investment he did? He did investments of 5 lakh rupee. I mean, he brought $10,000 on 1st April 2016, and at that time dollar was nearly 50 rupees, and he invested 5 lakh rupees in my company. I really worked hard. I gave my sweat, I gave my blood to the business. I tried to increase the wealth of the shareholders. And after too much of hard work, 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 in 2024, I am at a stage where I grew the money of Joey Tribbiani, grew the money of Joey Tribbiani, and now his wealth turned rupees 10 lakh rupees. Oh wow! In just 8 years, paisa double, money doubled. In just 8 years, his money got doubled. Oh, wow! When he was taking back this 10 lakh rupees, he asked for conversion. He asked for conversion, and at that time, exchange rate was rupees 80. How much did he take with himself? He just took $12,500. Let me do the maths. Yes, 12,500. He came up with $10,000. Now he's taking back 12,500. But there is somebody who is laughing. I mean, there is a lady smiling. Where is tax? Where is tax? Where is tax? There is a lady laughing in the corner. Her name is NM. Sorry. NS. Her name is NS. And she's saying, Joy ji, Joy ji, Joy ji, this is the Kanun of the country. I want tax on 5 lakh. Joy feels cheated. Don't you think there is something wrong with this transaction? There is something wrong with the taxation system right now. Joy feels really cheated. And it is logical why. It is logical why he feels cheated. He came with $10,000 and he's carrying away 12,500 US dollars. But if you check out the value of the shares, it grew from 5 lakh to 10 lakh. Now, Nirmala Sitharaman ji wants tax on 5 lakh because that is the actual increment that he has got. In fact, he has just got increment of 25%. If you just understand, if you try to understand, you would see that it might appear that money has doubled. It might appear that money has doubled. So see, if you look at this point, it might look that money has increased by 100%. But if you check the actual value, then what would happen? Only increase has been 25%. He feels cheated. Are you understanding the issue? Are you understanding this is a clear issue? This is a clear issue that has to be answered now. So that has been answered by first proviso to section 48. How this has been answered? First of all, for all securities, this proviso is applicable for all securities other than 112A. On 112 it is not allowed. Second thing, only non-resident or foreign company investing in India are given this option. What option is given to them? Provision says calculate capital gain in foreign currency. This is the benefit given to them. This is a small benefit given to them. What benefit it is given to them? Let me tell you. See how calculation normally takes place. Full value of concession would be 10 lakh. Cost of acquisition is nothing but 5 lakh. Capital gain turns out to be 5 lakh. Provision says just ignore this capital gain. Ignore this capital gain. Take these figures and convert them into foreign currency. When to convert? For full value of consideration, take the average dollar rate on date of sale. On date of sale, average rate given to us is 80. So divided by 80, which would give us full value of consideration as $12,500. This cost of acquisition has to be also converted with average dollar rate on date of acquisition. So we have to divide it by 50 and our cost of acquisition would be 10,000 and this would give us capital gain of $2,500. Now we have a dollar now. We have capital gain in dollar now. So that has to be converted in rupee to tax them. Provision says this has to be converted on date of sale with buying rate. Buying rate would be nearly around 81 only. It might be 82, but assuming it 80 only, now we just have to multiply it by 80. 2500 into 80 would be 2 lakh rupees. So 2 lakh is the actual amount that is being taxed, because 2 lakh is the actual gain on account of money he is getting, that should be only taxed. So 2 lakh government will tax. Only point of discussion in this point is how do we calculate capital gain in case non-resident or foreign company invests in India. And second thing, if computation is done, how that computation would be done in foreign currency, which rates to be taken, that is what the point of matter is. Let me take you in the book and that will tell you the actual scenario. What this provision says: if any non-resident or foreign company on sale of debentures, shares of Indian company are acquired by purchasing reinvestment, just ignore this point. Provision says capital gain shall be calculated in foreign currency. Whatever capital gain is there, that shall be calculated in foreign currency. So ignore the foreign exchange gain or losses. Just because foreign exchange gain losses are too much, so actual capital gain should only be taxed. For that matter, provision says capital gain would be considered in foreign currencies only. Now, how do we compute? Provision says cost of acquisition shall be considered, shall be converted average of buying and selling rate on the date of acquisition. Like in our case, average was 50, so we divided by 50. Full value of consideration and transfer expenses shall be taken by average rate on the rate of transfer. So in our case, it was 80, so we divided by 80. And capital gain that was arrived at $2,500, that would be converted with buying rate on the date of transfer. Whatever the buying rate is as on the date of transfer, that would be used for conversion. Remember, SSC has to be non-resident in the year of transfer, and indexation is not available. See, if you are getting this benefit, then indexation benefit is not given to you. And this is what I wrote here. This is what I wrote here, that indexation benefit is not given. Even before 23rd July, also indexation on these assets are not available. After तो किसी पे भी available, it is not available any assets after 23rd July, but before 23rd July also indexation is not available to such non-resident who are opting for this proviso. Got this point? Got this point? First proviso. Anybody having any doubt in this first proviso? Hmm? Sir, yesterday we understood the definitions, understood the special considerations, and how do we compute full value of consideration. Today, since morning, we started off with bonus, ESOPs, demerger right, intangible assets, exempt transfer, we understood. Then we came on to provisos, and we understood indexation, and we understood how do we compute full value of consideration in case of non-resident just investing money in India. So just to ignore the foreign exchange fluctuations, we compute in full value of consideration. We had two provisos basically, first and second. First talks about non-resident, second talks about indexation. This is what we had studied since morning. Can I say that to now, whatever we have studied, we will be able to compute capital gain in any case? In normal circumstances, whenever we are given a question, we will be able to calculate. Now we have to switch forward to some advanced cases. Some advanced cases. I think we do have sufficient time. I want to take you through these advanced cases and then we'll switch to these one. I want to take you through these advanced cases. For that matter, I want all of you to come on to ULIP taxation. ULIP taxation. Just asking you, can we move forward? Anybody having any doubt up to this point? If you have a doubt, now just ask. If you have a doubt, just ask. See, I will be telling ULIP taxation the way you have never studied it before. So for that matter, whatever the previous backlogs are must be clear in your brain. You must not have any doubt till now. Even though that the upcoming portion is not relevant to what we have studied, But we must be aware. We must be aware of all the things that we have completed. Right now, I'm going to start with ULIP taxation. I want your full attention at least for next 20 minutes. Full attention. Sir, what is the basic premise of ULIP taxation and what is the basic premise of LIP? Let me tell you what happens. Every month we pay certain money. For example, I pay 2,000 rupees per month. For now, why are we taking buying rate? There is logic to it. There is logic to it. See, whenever Joey would be converting that money, Joey would be selling. Joey would be selling the shares, so he would require dollar na. So sales will be made in rupees. He would be requiring dollar na too. He would be buying dollar. He would be buying dollar. So actually he's buying just $2,500 na in benefit. So buying rate is considered. Naskar. Like he would be selling in rupees, he would be selling the shares in rupee, and he would be buying the dollars. So actually, he's just buying $2,500 of gain. So 2,500 is considered with buying rate. That is why we use. Okay. See, coming on to ULIP taxation. Basic premise of LIP and ULIP is just this thing. LIP talks about life insurance. ULIP talks about unit linked insurance policy. Both the cases, people are being insured on their lives. Life insurance. These both are life insurance. But what happens? LIP, entire money goes for insurance. But under ULIP, some of the money goes into insurance and some of the money goes to mutual fund. This is what the basic difference is. Okay. Another important thing under LIP and ULIP, there is a minute difference between the two. Both, first of all, both of them are covered under 1010D. What this 1010D says? 1010D talks about one thing. Provision says that if you have acquired any LIP or ULIP prior to 1st April 2012, before 1st April 2012, and annual premium is lesser than or equal to 20% of sum assured, then it would be exempt. And after that, it is 10%. Annual premium is less than or equal to 10% of sum assured. Of course, for disabled people, it is 15% of sum assured. So basic premise under 1010D is that annual premium has to be less than 10%, 15%, or 20% in different cases to make this policy exempt in future. In ULIP also, in LIP also, in both the cases, policy annual premium has to be lesser than 10% or 15% or 20% to make this policy exempt. This is the basic premise of life insurance policy. Then only life insurance policy would be exempt. Otherwise, it would be simply taxable. Got it. Whatever benefits on life insurance policy you are getting, that is exempt only if premium is within limit, and that limit has been given by under 1010D. That has been given under 1010. Basic premise it is. It is exempt only if premium is within limit. Now, what have used to happen? As I already told, if it is within limit, then it was exempt. But if it is beyond limit, then ever since it has been taxable under IFOS. If it is ULIP, if it is LIP, it is always taxable under IFOS. If you are buying any life insurance policy, if you are buying any ULIP on which premium exceeds 15%, premium exceeds 20%, premium exceeds 10%, then it is always taxable under IFOS, irrespective of whether it is ULIP or it is LIP. Irrespective. We don't have to consider. See, 10%, 15%, 20% is the benchmark for us. Okay. First thing has to be checked is whether the premium is within 10%, 20%, 15% limit. Simple thing. If it is breaching that limit only, then it is simply taxable under IFOS. It is simply taxable under IFOS. Basic thing, it is simply taxable under IFOS. But sir, what if it is within limits? What if it is within limits? Earlier, it was exempt. Earlier, if you used to buy any ULIP or LIP, it was exempt. But right now, position changed. For ULIP, government was very lenient. Buy ULIPs, we have no issue. But what used to happen? People used to have much benefit. People used to invest in mutual fund through ULIPs, and they used to have multiple capital gains, and that two capital gains were exempt. So government came on with amendment, and this amendment is not new. It came in 2021, but it has not been tested in exam even today. So for that matter, it is important. Provision says if you have bought any ULIP prior to 1st Feb 2021 and it fulfills the 10%, 15%, 20% criteria for the premium, it is going to be exempt irrespective of the year, irrespective of the amount, it is going to be exempt. Whether you bought 1 crore per month, whether you bought 100 crore per month premium, whether you bought 1000 crore premium per month, we do not care, it is going to be exempt. Normally ULIPs, what happened is now people used to double their money because they had exposure in mutual funds. So ultimately through ULIPs, people used to not just ensure their life, but rather they used to expose themselves for mutual funds. And it was exempt because of this 10% criteria. Provision says even if it is less than 10% now, even if it is up to 10% now, we are going to tax it with effect from 1st Feb 2021, and not simply tax it. Provision says if you have any ULIP up to 2.5 lakh rupees, any ULIP or multiple ULIPs together up to 2.5 lakh rupees, we are going to exempt that on majority. But if you have any more ULIP exceeding 2.5 lakh, or if you have a ULIP, single ULIP in itself exceeding 2.5 lakh rupees, then it is going to be taxed, and it is going to be taxed under capital gain head. This is what capital asset is. Any ULIP which is exempt under 1010D, which is exempt under 1010D but exceeds 2.5 lakh rupees in annual, that is a capital asset. ULIP which is under 1010D na, which is less, which is exceeding 10% limit na, it is not a capital asset. But if a ULIP which is following the 10% criteria, 15% criteria, 20% criteria, but is exceeding beyond, but it is beyond 2.5 lakh na, that is only the capital asset, and that is taxable under that capital gain. Let me take an example for you to understand. Let me take an example. This will make you understand this topic even better. On 1st Jan 2021, I bought a ULIP in which annual premium was 5 lakh rupees and sum assured was 50 lakh rupees. Am I fulfilling 10% criteria, 15% criteria, 20% criteria? Let us suppose 10% criteria only exists, 20, 50, 15% I'm ignoring for right now. Am I fulfilling 10% criteria? Right answer is yes. My annual premium is up to 10%. And before 1st Feb 2021, any ULIP that is acquired, if it fulfills 10%, it was exempt. So it has to be exempt. Oh wow, sir. Oh wow. It's completely exempt. Now let's see. On next month only, I got too much of money. Too much of money. What did I just do? I bought another ULIP whose sum assured is 12 lakh rupees and annual premium is 1,20,000 rupees. Am I fulfilling 10% criteria? Try answering it. If not via chat, try answering it in your brain. Am I fulfilling 10% criteria? Right answer is yes, sir. Again, premium is 10%. Should this be exempt? Now we have another condition. Now we have to check whether annual payment is up to 2.5 lakh. So old ULIPs have to be ignored. Old ULIPs have to be ignored for 2.5 lakh limit. Right now, I am just paying rupees 1,20,000 rupees. I am just paying 1,20,000 rupees and it is within limit. So ideally, this should be exempt. This should be exempt. On the very next month was Feb. Now in March 2021, again I got some money. I bought another ULIP. Sum assured 13 lakh rupees. Sum assured 13 lakh rupees. Annual premium 1,30,000 rupees. In this case, am I fulfilling 10% criteria? Yes, sir. Premium is up to 10% only. I am fulfilling that criteria. If I am fulfilling that criteria, I have to check whether annual premium during the year is up to 2.5 lakh rupees. Sir, 1.2 lakh this, 1.3 lakh this. That means annual premium is up to 2.5 lakh only. That means ideally this second ULIP shall also be exempt. Oh wow, sir, wow, this is also exempt. Basically, this is also exempt. Exempt. On the very next month, on 1st April 2021, the new year as per finance year, new financial year started. I got some more money and I bought a ULIP on which sum assured was 2,40,000 rupees. Sorry, 24 lakh was the sum assured and premium was 2,40,000 rupees. Another ULIP I bought. In this case, if I ask whether this fulfills 10% criteria, it answers again, sir, it fulfills 10% criteria. Again, this fulfills 10% criteria. Whether annual premium is up to 2.5 lakh rupees. Ideally, yes, sir, annual premium on this ULIP is up to 10,000 rupees. But think of it in this way. In previous year 21-22, on 1st April, I am paying this 2.4 lakh rupees. But in Feb and March, I will be paying 1.2 and 1.3 lakh. So annual premium exceeds the 2.5 lakh rupees. And now some taxation would lie. Some of the ULIP would be taxed right now. Now, how some of them would be taxed, let me tell you. Provision clearly states whatever ULIPs you have, just collectively select a few of them and make them exempt. Whatever ULIPs up to 2.5 lakh you think you can exempt them and rest would become taxable. So here we have two choices. Are you with me now? We have two choices. Either we can make these two ULIPs collectively as exempt and tax this. This is one choice we have. Or vice versa we can do. We can do exempt this and tax these two. Anjana, just for the sake of simplification, it has been said that any ULIP prior to 1st Feb 2021 has to be ignored for 2.5 lakh limit. Because if somebody had acquired 1 crore worth of ULIP in a month, he would be taxed. He would be taxed a lot at once. So that has to be ignored. That has to be ignored. See, on 1st the provision came. So government cannot tax anything retrospectively. These were bought with an intention of exemption. So the government did not allow. The government did not want to tax you retrospectively. See, now here we have two options. Again, repeating. Either we can use these two ULIPs as exempt because a premium is 2.5 lakh per annum and tax this. This is first option available. Or second option is we can either exempt this 2.4 lakh and tax this thing. We have either of the two. Which one should we choose? Sir, the option with better tax benefit we will be choosing now. If we are going to exempt ULIP now, these two ULIPs, our capital gain saved would be nearly 7 lakh rupees. But if we are choosing this as exempt, fourth one, then 5.8. So it is always beneficial not to choose these two because more capital gain is going to be exempt in future. And that is what you have to decide. Are you getting the point that only 2.5 lakh worth of ULIPs are only allowed as exemption? Beyond that, any ULIP is taxable. For example, ULIP number 5, 35 lakh is the sum assured, 3.5 lakh is the annual premium. Am I fulfilling 10% criteria? Yes, sir, I am fulfilling 10% criteria. Is this ULIP exceeding 2.5 lakh? Yes, it is exceeding. Therefore, it is taxable. Therefore, it is taxable. Flat taxable. Whatever money I will be receiving, it will be taxed. And the best part is it is going to be taxed under section 112A because most of the money that ULIPs invest is in the mutual funds and equity-oriented mutual funds. Therefore, it is taxable under 112A. Oof, 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 oof. This was all about your ULIP taxation. Everything summarized. Anybody having any doubt? Even though I'm not done yet, but anybody having any doubt till now? Anybody having any doubt till now? So financial year change, then why are we considering 1.2 lakh and 1.3 lakh? Anyhow, what provision says during any of the financial year, your premium should not exceed 2.5 lakh. So for first ULIP, you are not just paying premium for 1 year now, you have to pay for every year now. So in next year, if you are going to buy new ULIPs, how will that be allowed? For any financial year, your ULIP should not. I'll show Anjana. For any financial year, your premium should not exceed 2.5 lakh. Whether be it single ULIP or multiple ULIP, any premium should not exceed. If it exceeds now, only ULIPs on which premium is up to 2.5 lakh that should be allowed. That should be allowed. Because what would happen every year you are going to buy new ULIPs. This year you are buying 2.5 lakh. Again you will buy, next year you will buy 2.5 lakh. Again next year you will buy 2.5 lakh. Arey Baba, if you will buy this much, then government is not going to get any tax now on this. There will be a year where you will be paying at least a 10 lakh worth of premium, because if you buy ULIP today, next year also you have to pay the premium. Next to next year you have to pay the premium. So after 5 years you will be paying five premiums. Five ULIPs you will be paying premium. So it would be not justified now. If after 10 years you are paying premium for 10 ULIPs, 25 lakh you are paying. Getting it, Neha. You premium for ULIP is not just paid for 1 year; it is paid every year. So that 2.5 limit is year wise. Ranjana, can you show the example of the screenshot? See this example. You can take this example. I'm just removing the scribbled portion. Smart move. Got it. Smart move is not that thing. Smart move is that you are able to understand it. It is not that simple that you can see. It has been simplified by me. And if somebody wants to take screenshot of this, it's open to them. But the best portion is not that thing. Best portion is this thing. This is the best thing that you can see. Not every teacher does the hard work of simplifying things to this level. If you are able to understand this chart now, you will be able to understand entire ULIP, entire LIP. Thanks, Sir. Perfect. Now, this was all about ULIP taxation. Sir, but government did not stop there, nor did Nimotai. They found out that people are misusing ULIP for tax purpose. They found out that people are exposing themselves to mutual funds by investing in ULIPs and gaining in lakhs and lakhs of rupees. So they taxed ULIP. In 2021, they brought an amendment and they fixed the limit of ULIP to maximum which you can buy, and beyond that it would be taxed in future. They brought this amendment. But later on, Nimo misusing LIP, and let me tell you how. What the concept of LIP is, let me tell you how people were misusing it. Let me tell you how. If, for example, I am Rahul, 2000 rupees per month I am paying as premium for LIP. 2000 per month imply 24,000 a month, 24,000 annum. And for 20 years, if I am paying, I will be paying 4,80,000 rupees. And on 21st year end, I am receiving 6 lakh rupees. Do you think this should be taxed? Arey Baba, in 20 years, I am just getting 20% return. It is not, this should not be taxed. This should not be taxed. Logically, this should not be taxed. And if you check 1010D, it should be exempt also. If you check 1020 sum assured, whatever the sum assured is, 4.8 lakh or 6 lakh, whatever the sum assured is, I am paying premium less than 10% to that. So it is that is exempt. Of course, that is going to be exempt. And logically, this is exempt also. And if in 20 years I'm just getting 20% return, it is least relevant. Government is not going to bother at all. Government does not want to tax this. And that was so the case. Earlier, this was not taxed. But what if, think of it from somebody who is putting too much money. This is Rahul. This is just Rahul who is investing 4,80,000 rupees in 20 years. But somebody who is Mukesh Ambani, who is investing maybe one, two, three, four, five more zeros to it. How much amount this turns out to be, I don't know. Ultimately, what used to happen? I was getting a big benefit of 1,20,000, which was negligible for government. But if somebody uses this life insurance policy for their benefit, for their gain, then it is something that government is interested. 1, 2, 3, 4, 5. This is the amount that somebody would be earning if he is investing too much in life insurance policy over the 20 years. Not relevant. Even over 20 years, if somebody is investing in LIP and earning this much amount, the government wants to tax this. So for that matter, government came up with another amendment for LIPs. What used to happen? Any your life insurance policy which was issued up to 23rd July, sorry, up to 1st April 2023, it was exempt on maturity if it fulfilled 10%, 15%, 20% criteria. Any LIP issued, see, up to 10% premium now, if you are having any LIP, it is exempt. If you bought LIP worth rupees 1 crore, 10 crore, 100 crore, 1000 crore, don't not matter, not relevant. Any LIP that you buy, if it fulfills 10% criteria, it was exempt. Simply, it was exempt. No issue whatsoever. But sir, if LIP is issued after that, government put a cap, upper cap. Provision says not just one, but collectively, whatever LIPs you buy, if if value of such a premium is up to 5 lakh rupees in a year, is up to 5 lakh, then only they will be exempt. Otherwise, they shall become taxable on whatever LIPs the premium exceeds 5 lakh rupees in a year. Na, that would be taxable, and taxability would arise under the head IFOS. Best part of it is taxability arises in IFOS. ULIP is taxed under capital gain, but LIP is taxed under IFOS. That is important portion. Did you get this point? The same we calculated for ULIP if we bought any ULIP before 23rd, before 1st Feb 2021. Similarly, we have to do for LIP also. If you bought any LIP before 1st April 2023, it will be exempt if it fulfills 10% criteria. But if any LIP is issued after thereafter 1st April 2023, you have to check aggregate of LIP. If it exceeds 5 lakh, then whatever LIPs exceeds 5 lakh will be taxed. Whatever LIPs remains after considering 5 lakh limit, that shall also be taxed. Only LIPs up to 5 lakh rupees will be exempt in future. Otherwise, every LIP is going to be taxed in future. And LIP would be taxed in IFOS. Sir, even though this point holds not too much of value right now, but still I'm going to ask. For example, if I bought a LIP, annual premium is 4,80,000 rupees. And GST at the rate 18%. See, GST has been removed in this last month. 2 months ago, it was removed. But for your Finance Act, for your attempt, the GST might be applicable, huh? Because for previous at 24-25, GST was applicable. So if I consider 18% GST after GST amount turns out to be 566,400. I want to ask whether this will be exempt or taxable on maturity. Before GST premium is 4,80,000 rupees. After GST premium exceeds 5 lakh rupees. So should this 5 lakh limit be exclusive of GST or including GST? My question to all of you. My question to all of you. Should this be excluding GST or including GST? Anjana says this should be exempt. And ideally, yes. Ideally, yes. And this is not just me speaking. This is what government has given circular. Government has given the circular that if you are considering 5 lakh limit, then it's exclude GST. See, just because of GST, government doesn't want to tax it now. So for that matter, provision says excluding GST, you have to consider 5 lakh limit. Excluding GST, you have to consider. Sir, we got your point. We understood. We understood to the depth. Okay. Another important point. Another important point in this LIP. Another important point. For example, I bought a life insurance policy. Annual premium is 6 lakh rupees. Okay. Annual premium is 6 lakh. I paid for 10 years, and on maturity, I got 80 lakh rupees. Whether premium is within 10% limit, right answer is yes, it is within 10% limit. Whether it is it is in 10% limit. Yes, it is in 10% limit. Is it exceeding 5 lakh? Yes, it is exceeding 5 lakh. So should this be taxable on maturity? Yes, this should be taxable on maturity. Okay. How taxability would turn out? Full value of consideration would be 80 lakh, whatever amount we are receiving. Cost of acquisition will be 6 lakh into 10 years would be 60 lakh. This would give us 20 lakh rupees, and this would be IFOS. Are you able to understand this thing? How do we compute? How do we compute income in case of LIP? Are you understanding how do we compute? Are you able to understand how do we compute? Sir, here is a catch. Here is a catch. Government has specifically laid down a guideline that if you are buying any life insurance policy, if you are buying any ULIP on which you have taken deduction under ATC. See, if you buy life insurance policy, you get deduction under ATC. You get deduction under ATC for ULIP also. Provision says if you have taken deduction under 80C, then such amount of deduction shall be reduced from cost of acquisition, and that reduced cost of acquisition shall be considered for the purpose of taxation. That means here in this case 4.5 lakh into 10 years, 45 lakh would be cost of acquisition, and my capital gain would turn out to be 15 lakh. This is what this point says, that if you are buying any LIP or ULIP and you are also taking deduction at ATC, cost of acquisition shall not be allowed. Same thing we studied, that if you have already taken deduction of any of the expenses, any of the head of the income tax, then you are not allowed such expenditure as cost of acquisition. Last point for ULIP. Last point for ULIP. Last point for the ULIP. Provision says, provision says, if you buy ULIP, never thought of that. Array, you are going to see so many of instances that you had never thought of, that were not even covered in your regular classes, are going to be covered in this session. You need not to worry. You just have to sit and focus on what I'm saying. What I'm saying is, if you buy ULIP exceeding 2.5 lakh rupees, it should be taxed. Yes, it should be taxed. If you buy LIP exceeding 5 lakh rupees, it should be taxed. Yes, it should be taxed. Provision says both these LIPs or ULIPs received on account of death of the person are exempt. Received on account of death of the person are exempt. If you are investing even 2.5 lakhs or more, but if person dies and you receive ULIP on account of that, that exempt. If LIP also received on account of death of the person, irrespective of the premium, it is being exempt. That is what this point is all about. And that completes your ULIP taxation. Let me summarize it for you. Whatever you have understood, well and good. If you did not understand, just try understanding this with me. I'm again saying everything that I have said. I'm just summarizing. This power batch is only a summary of the entire batch. I'm here to just to revise you. And again, we are revising in a revision. Wow. So try understanding this. If we have any kind of life insurance policy or LI or ULIP, if it exceeds 10% criteria, then it is always taxable under IFOS. Irrespective of whether it is ULIP or LIP, it is taxable under IFOS. But if it is fulfilling 10% criteria, then you have to go separately for ULIP and LIP. If you have a LIP, sorry, if you have a ULIP, any ULIP issued up to 1st Feb 2021 is exempt irrespective of the premium. It just has to fulfill 10% criteria. Any ULIP issued after 1st Feb 2021 has to be checked for annual premium of 2.5 lakh. Any ULIP up to 2.5 lakh would be exempt, beyond that it would be taxable. Simple point. Similarly for LIP, any LIP bought prior to 1st April 2023 is exempt, but if bought after, then you have to check. Maximum LIP that is going to exempt is 5 lakh rupees premium per annum. Beyond that, it would be taxable. ULIP would be taxed under capital gain head under section 112A. LIP would be taxed under IFOS. In both the cases, you have to exclude the GST amount while computing the limit of 2.5 lakh and 5 lakh. In both the cases, if you have taken deduction under 80C, so you will not be allowed deduction of such expenditure as cost of acquisition. In both the cases, if you receive any maturity on account of death, it is going to be exempt. That was all about ULIP. Just a 2-minute brief. Oh wow, sir. Wow, wow, wow. Wow, chicka, wow, wow. Done with LLB. Everybody, everybody with me? Sir, has this ever been asked in exam? I have not seen this being asked in exam. Can this be asked in exam? Of course, this is going to be asked in exam. Some or the other year, it is going to be asked in exam. I have seen faculties writing down nearly 5 or 7 pages just for ULIP taxation and telling this summary only that I told you. This only summary that they tell. If you see institutes module, ULIP has been given under capital gain head, LIP has been given under IFOS head, and there is entire duplication of work. So your work has been done. And now see, I'm not just boasting this thing, but now you will understand the value of the batch. See what it appears now. He is going to just teach the concepts. Now, I am already aware about the concept, so I don't need to go for the batch. I'm just telling the reason. This is what we do, and an entire batch I am going to do this. I'm not just telling this thing, but I know what students don't know. So for that matter, I emphasize on those areas that are going to be asked that you are not aware, at least on the topics that you feel you are familiar. I must be the one who should tell that this is how it is done. Okay, sir. I don't want to go into that detail. Moving on to next special case, that is slum sale. See what happens if you don't want to sell the entire business, or if you just hive off one of the unit of your business. It is considered as slum sale. Let me tell you an example. I have seen slum sale in my real life also. So I can tell. There is a company called Mamarika. Okay, Mamarika. Now Mamarika has two units. Mamarika has two units. One is B2B and one is B2C. Not B2C, actually D2C. B2B and D2C. What Mamarika does, I'm just briefing you out. Mamarika has a business of making toiletries. If you understand toiletries, if you go to any hotel like Marriott, if you go to Al Hayat, if you go to Sayaji, if you go to any such big hotel, you would see now there is a bathroom kit available which has small soaps, small perfume, small shampoo, slipper. Everything is kept for the guests. That you try to steal, na, that the things that you try to steal from the bathroom, all the things are being made by this Mamarika company. Now, this company had two business models. Why I am telling just for real life instance, this company had two business models. First of all, it was directly into B2B business. That means this Mamarika used to sell these toiletries to directly to the hotels, to the business owners. This is business to business model. Similarly, Mamarika had also a business of selling it directly to the customer. For example, Mamarika had outlets in airports. Somebody used to travel, want to buy this kit, they can buy at Mamarika. Somebody who is going to a mall, their outlet was there. They had shopping cart at multiple outlets. So direct to customer was also one of their business. But issue was B2B was doing good, but D2C was not doing good. Why? Because at airport, at malls, the rental is too much, and the rental is not sufficient. I mean, their earning is not sufficient to take out even rent. So for that matter, they decided to sell this D2C unit to some company called HOB. They decided to sell off this unit to HOB. And what consideration they received? They received consideration of 64 crore rupees. 64 crore they received. And in return, what did they give? They gave their permissions, licenses, they gave their inventory, they gave their daters, they gave their creditors, they gave their cash, they gave their bank balance, they gave their investments, they gave the brand value of Mamarika. Everything that they gave is for 64 crore rupees. Now, now issue here is Mamarika is giving away investment, which is a capital asset. Mamarika is giving a cash, which is not even a capital asset. Mamarika is giving inventory, which is not a capital asset. Ultimately, they are hiving off the entire unit. Every asset has different cost of acquisition, but sir, everything would be categorized as capital gain, and it is the topic called slum sale, where a single value is assigned to the entire business. Not individual value is sold, not individual asset is sold. Entire business is sold for a single consideration. This is what slum sale implies. Now, in slum sale, computation is very simple. Computation is very simple. We want two things: full value of consideration and cost of acquisition. We only require two things. But in these two things, we have slight complication. What's that slight complication? For full value of consideration, we need to consider FMV1 and we need to consider FMV2. And for cost of acquisition, we need to consider net worth. And that is what the subject matter of discussion is. How do we compute FMV1? How do we compute FMV2? And how do we compute net worth of an organization? How do we compute these things? This is what the subject matter of discussion is. How do we compute these things? Did you understand what is slum sale? And what is the thing that we need to study? Only three things we need to study. How do we compute FMV1? How do we compute FMV2? And how do we compute net worth? Let me tell. I'm not referring to any material. I'm not referring to any material. I'm just referring to what I know and what I want to tell. FMV1, FMV2, cost of acquisition. I'm just writing down the things. If you want to jot it down along with, it would be great. If you don't want to, I will be sharing these board notes to you. See, how do we compute cost of acquisition? Cost of acquisition is computed via multiple manners. If you have, you just have to see the balance sheet. On balance sheet, if you have any depreciable assets, in balance sheet, if you have depreciable assets, take WDV as per Income Tax Act. If you have any asset, other assets, like you can have inventory, it is not depreciable. And like you have debtors, it is not depreciable. Like you have investments, it is not depreciable. Take as per book value. If you have any self-generated goodwill, self-generated assets, if you have any 3580 assets on which 100% deduction has been taken, take it as net. Whatever liabilities you have, take at book value, reduce liability. This would give us net worth. Ultimately, whatever the cost of acquisition of the asset is, minus depreciation is the thing you are going to take. Whatever the cost is. Everything is taken at cost now. Depreciable assets are also taken at cost. Everything is every else thing is taken as cost. So this will give you cost of acquisition. Logically, it is correct. Depreciable assets bought at a price, written down value would be cost of acquisition only. Other assets at book value, liabilities at book value, everything at book value. But only the thing is, depreciable assets we take at WTV. So this will give us net worth. Very logical it is. But sir, what people do, they try to understand that government has something written on their forehead. They assume that government has written something on their forehead. Therefore, what people try to do, people try to revalue these things. For example, if they have assets of 100 crore, they used to revalue this for 300 crore so that their cost of acquisition would increase and their capital gain would decrease. So government has said any revaluation would be ignored. Revaluation would be ignored. And this depreciation is strictly as per Income Tax Act. Bas, simple. You will be able to calculate up. You will be able to calculate this. You will be able to calculate. Sir, ये सारा YouTube पे चलेगा. When no, only first 5 lectures in English would be on YouTube. First 5 lectures of Hindi would be on YouTube. And remaining all lectures would be on Fast App, that is on the paid basis. Please, if I will take everything on YouTube, what will I do? What will I do? How? I mean, I want to eat food now. If you go to a hotel, you eat food. You go to a dhaba, eat food. You pay money now. So how will I want some food now. For that matter, how can I keep everything on YouTube? Okay, just tell it. Okay, so it will not be on YouTube. When first 5 lectures only. Acha, got cost of acquisition. Got this cost of acquisition. Understood this cost of acquisition, sir. मजा ही आ गया. I got this point. Shall we take FME1 and FME2? Shall we understand? FME1 says assets given. FME2 says assets received. What does that mean? See, if Mama Rika is giving away its assets, Mama Rika is giving away its assets, you have to take the assets given FMV, or in FMV2, you have to take assets received FMV. What does that mean? If Mama Rika is giving away its land, so take SDV of that land, stamp duty value of land. If Mama Rika is giving away its shares, it had certain investments or any securities, take fair market value of these shares. If Mama Rika is giving away any jewelry, For example, Mama Rika had certain kind of jewelry in their business. They had certain kind of, for example, paintings in their business. Take that at open market value. If they had any other assets, they might have inventory, they might have cash, they might have FDs, they might have bank balance, anything that they have that can be taken at book value. And here, if any revaluation done, that has not to be ignored. Revaluation done, not to be, sorry, that has to be ignored. That has to be, that not to be ignored. If you have revalued or any plant and machinery, we will be taking the revalued one. Here, I'm not going to take any. We are not going to exclude revaluation. We will be taking revalued one because since we are computing full value of concession, government wants more and more full value of concession. For that matter, they are not going to remove any revaluation impact. They would take the revaluation impact. Don't worry, I'll take example just to make you understand how do we do it. Sir, which batch I would take for fast track for Jan 26? See, if you are able to understand in this batch, take this. If you are not able to understand, then I have a Safal batch, 150 hours, 100% concepts, 100% question answers, too much of writing practice, too much of MCQ practice. You can refer that. If you are able to understand this, then this batch is good for you. In evening, you can join for Hindi. Okay, right now, message me on when I message me on Telegram, I will be answering that. Any other assets take at book value minus liabilities. Minus liabilities. Liabilities at book value. FMB2 says assets received. For example, Mamarik after selling their business received cash, received bank, take that. Mamarika on selling the assets did not receive cash, did not receive bank balance, rather it received the shares. So these shares have to be taken at FMB. What value they are receiving? If Mamarika on selling their business received some kind of building, then take SDV of the building. Or if Mama Reka on selling the business received some kind of painting, for example, somebody sold entire business for a painting. So whatever the open market value of the painting is, that shall be considered, and this will be FMV2. So assets received is FMV2, assets transferred is FM1. Now, I know there are too many things that I have said, but this is the gist of the point. I am going to take an example. Right now, you might not have that example. I will be sharing superintended PDF in the evening or tomorrow afternoon. So till then, you will be having. Right now, I'm just referring the example for your understanding. There will be a question called Salary Limited. This question will be a part of your super 100 when I will be sharing the super 100. This question will be a part of your super 100. I'm solving this right now along with you. Try understanding what I'm doing. How do we calculate? Okay? Try understanding the format of how do we solve this question. Okay. Salsi Limited has two units. One is engaged in manufacturing of textiles, and the other one is engaged in manufacturing of chemicals. Okay, Salsi has two units. First one is textile, the other one is chemicals. As a restructuring drive, the company sold its chemical unit as a going concern by the way of slum sale. Company sold the assets by the way of slum sale for 242. Oh my god, that means entire unit has been sold for 242. That means can I simply say that FMV2 is 242? FMV2 is 242 because entire business has been sold for 242. So FMV2 is the assets received. We are receiving 242 lakh. That means FMV2 is the 242. On 1st October 2024, that means date of slum sale is 1st October 2024. Balance sheet of Salsi Limited on the date of transfer is this. Okay. See, important here is chemical unit is being transferred. Chemical unit is being transferred. Chemical unit is being transferred. Sir, if we are transferring chemical units, the other unit has to be ignored. This textile unit should be ignored now. Textile unit should be ignored so that we are not confused. We are not doing any mistake. For that matter, textile unit, I would request you to cut it down. Whenever you see any extra information, cut it down. Textile unit building, ignore. Machinery unit, textile unit of machinery, ignored. Inventories of textile unit, ignore. Licenses of textile unit, ignore. Trade credit of textile unit, ignore. All these things are all these things are irrelevant. But I'm not cutting it down right now. Okay. We have multiple assets. The following information has been furnished by the management. The chemical unit was started in COVID periods. The chemical unit was started in COVID year. COVID year, that means 2020. And we are selling it in 2024. That means 4 year has passed after commencement of business. That means any capital gain would be long-term capital gain. Any capital gain would be long-term capital gain. Provision says land of chemical unit was used by, was includes revaluation surplus of 20 lakh rupees. Land was purchased for 50 lakh rupees. Try understanding this. Land was purchase price was 50 lakh rupees. We revalued it for 20 lakh rupees and therefore it is appearing at 70 lakh rupees and revaluation surplus is 20 lakh. It appears that means purchase price is 50. After revaluation, land is appearing at 70. Okay, the stamp duty value of land is 62. Okay, stamp duty value is 62. Okay, SDV is 62. Got that point. Machinery and building have been shown as per written down value as per income tax act. Stamp duty value of the building is 72 lakh. See, this building is at WDV. It is correct. Machinery is also at WDV, but this building has a stamp duty value of 72 lakh rupees. Okay, sir. Okay, fine. Got this point. Got this point. Licenses were acquired on 1st June 2023 and have been showed at the original price. Are Baba, licenses are depreciable assets under Income Tax Act. I will be telling in PGBP that 25% depreciation are applicable on licenses. Equity shares were acquired through National Stock Exchange on 1st April 2022 and value recorded on 1st October 2024. That means on the sale of the slum sale, on the date of slum sale, they were at 42. So fair market value of these shares would be 42 only. We have entire information. I'm solving this with you. We want FMV1 and we want cost of acquisition. For the purpose of cost of acquisition, if I tell you, we want two things: depreciable assets at WDV, other assets at book value minus liabilities. Only these things we require. I'm just highlighting things in blue. If I have a land is a depreciable asset? No. For land, we require book value. And whether if any revaluation I have to ignore. So land will be recorded at 50 lakh rupees. Any revaluation has to be ignored. Yes. Building at book value excluding revaluation. Building at book value. Building is a depreciable asset. Yes, building is a depreciable asset. So we have to take WDV. Take WDV of the building. 70 lakh rupees is the WDV. Machinery, WDV 52 lakh, correct. Investments, are these depreciable assets? No. So whatever the investments are appearing, we have to take at book value. Take this thing. Inventories, book value. Licenses are depreciable assets. We have to take licenses as per WDV. So 23 lakh was the purchase price minus depreciation for 1 year. 23 lakh minus 25%. That means 17 lakh 25,000 would be the value of licenses. All these blue ones have to be added for the value of the assets, and this red ones are to be reduced. 47 lakh is to be reduced. Try doing it now. 50 lakh plus 70 lakh plus 52 lakh plus 35 lakh plus 60 lakh plus 17.2 minus 47. This would give us cost of acquisition. Cost of acquisition as 237.2 lakh rupees. 237.2 lakh rupees is the cost of acquisition. Did I do some mistake? 50 plus 70 plus 52 plus 35 plus 60 plus 17.25 minus 47. 25 at 237.25. This is the amount of cost of acquisition I am arriving at. Fine. Now I want FMV. FMV1. How do we arrive FMV? If we have any land or building, take at stamp duty value. I am highlighting things in this color. Lands SDV is 62 lakh. Buildings SDV is 72 lakh. Perfect. If we have any investments, shares, these are to be taken at FMV. FMV of share is 42. 1 lakh shares at 42. That means 42 lakh is the FMV of the shares. Consider that. That will be considered as full value of consideration. Inventories would remain same in both the cases. And licenses, sir, license is important. Any other asset is considered as book value. Licenses, extra licenses, machinery would be considered book value. So licenses here would be taken at book value. So all these colors I have to add, and liabilities I have to reduce. Liability again I have to reduce. Consider 62 lakh plus 72 lakh plus 42 lakh plus 60 plus 23 minus 47. That means 212. 212 is the FME1. How do we arrive? How do we arrive at calculation? FME1 is 212. Whichever is higher, we have to assume 242 is the amount of full value of consideration minus cost of acquisition is 237.25. This would give us 4.75 lakh of capital gain. Let me see answer. Fingers crossed. Okay, I did some mistake. I did some calculation error. Ek minute, I did some calculation error in FMV1 calculation. 62 plus 72 SDV plus 42 plus 60 plus 23. Am I missing out something? 62 plus okay. I missed out the machinery. No, I missed out the machinery. 62 plus 72 plus 52 plus 42 plus 60 plus 23 minus 47. So 264 would be the full FMV2. 264 would be the FMV2. 264 would be the FMV2, and this would increase the 264, and 264 reducing to 37.25. This would give 26.75 lakh would be the capital gain. 26.75 lakh would be the capital gain. Now, sir, if we do this way, we are going to, of course, do the wrong answer. Most oftenly, you are going to do wrong. But how you have to do? You have to do in this manner only. As of now, when you are practicing, you must be able to do in this manner only. No other method should be thought by you. You should be doing in this manner only. This is how you have to solve when you are at home, when you are trying to do the practice. How you have to write an exam, I am referring that point. So I'm telling you how do we write the answer. I told now we will be doing writing practice, but for that matter, I thought why not I write the answer and tell you what mistakes I did and how do we actually write the answer. So for that matter, I have written this answer for you. See, this answer has been written in a format as if I were writing this in exam. We will start with computation of capital gain in the hands of Salsi. Previous year assessment. Yeah, this is to be written. Now, full value of consideration, write it down. We will calculate full value under working note number 1. Minus transfer expenses, we have nothing. Cost of acquisition, working note number 2. LTCG, working note number 3. Everything will be done in working notes. Only thing we need to write is the format. Once we start computing working note number 1, we will arrive at full value of consideration. Full value of consideration will be higher of FMV1, FMV2. FMV1, you have to take building, SDV. We arrived at SDV. We would be taking shares at FMV. We arrived at FMV. Other assets, jewelry, do we have? No, we don't have. Any other assets? We have machinery, we have assets, we have licenses. 135. All in all, we have all the assets at 311. We will be reducing liability and we will be arriving at FMV1, that is 264. FMV2 given in our case is 242. Whichever is higher would become full value of consideration. Therefore, our full value of consideration will be 264 as our case. Now, working note number 2, computation of net worth. We have land at cost. We will take machinery at WDV, building at WDV, investments at cost, inventories at WDV, patents. We have to reduce depreciation. After reducing trade creditor, we will arrive at net worth. This will be put to the answer, and our capital gain would be computed accordingly. Important point. Note number 3. Since unit is being open for more than 36 months, in that case, capital gain computed will be long-term capital gain as per section 50B, and this is how you are going to present in exam. This question has been asked in November 24. I hope you are understanding the format of writing the answer. You don't have to follow the complicated method that has been given in the book. It is okay for you all to write the answer the way I told you. See, this, even though in book also it is given in a simpler format, but if you want to write it of your own, this is how you are going to write. I told you the manner in which you have to write the answer. Are you understanding? I have written down many answers for your reference so that you are able to understand how do we actually write, how do we humanly write the answer in exam. Most oftenly, we as a student face understand issue as to how do we write write answers in exam. Most oftenly, we are not able to recall the language, we are not able to recall the format. Some formats given in the book are typically complicated, so for that matter I have written down these things accordingly. You can follow these methods. I will be sharing this answer writing practices also with you, and not just practical chapters. I have written down theoretical chapters like tds also. How do we write tds questions? I have also written them down. I will be also sharing this sheet with you so that you are in a practice to write the answers as well. Okay, just taking you through the theory of the slum sale. This is what the provision is, and I told you the example also. Just taking you through the provisions. What does this provision says? Slum sale means transferring the entire unit without assigning individual value to a single asset. How do we compute? Take full value of consideration, reduce transfer expenses. This will give you net consideration, reduce cost of acquisition. See, in slum sale, we never index any cost. In slum sale, we never index any cost. Whatever cost of acquisition is given to you, we are going to take that only. Our short term, long term capital gain will be dependent upon the period of holding of 3 years. Sir, we don't have to check. We don't have to check the transfer date in this case. For slum sale, period of holding has not been reduced to 2 years, as I had discussed yesterday. For slum sale, even today, period of holding is 2 years only. We don't have to check 3 years period of holding for slum sale. Why, sir? Why? Because 50B explicitly says that slum sale has to be governed under 50B, and 50B says 2 years of 3 years of period of holding has to be checked. 3 years of period of holding has to be checked for slum sale. Every asset has been subsumed to 2 years of period of holding to make it long term, but slum sale is yet to be held for 3 years. A business has to be held for 3 years, then only it will become long term. How do we compute net worth of an asset? See, any depreciable assets would be taken at WTV. Any revaluation done shall be removed. 3580 assets nil, self-generated assets nil. Then any other assets, we have inventory, we have investments, we have debtors, anything else we have, that will be taken at book value. Reduce the liabilities, and this would give you net worth. Sir, if net worth is negative, that does that mean our cost of acquisition would be negative, our capital gain would rise? My answer is no. If net worth is negative, take zero. Any revaluation done in these figures now have to be removed, because revaluation would increase your cost now. Government would not allow. How do we compute FME1? FME1 says take the immovable property stamp duty value. Whatever the immovable property you have, take the stamp duty value of that. If you have any shares that are being transferred with the unit, take the fair market value of those shares. If you have any jewelry, painting, sculptures being transferred through the unit, take the open market value of that. And whatever other assets you have, take the book value of those assets. This will give you FM1, reduce liabilities. Assume, see, and understand, share capital, reserves and surplus, dividend, provision for tax, uncertain liabilities, contingent liabilities. These are not actual liabilities. Actual liabilities imply bank balance, overdraft. These are the bank draft, bank loan. These are overdraft liabilities. I mean, these are not liabilities. Share capital, reserves and surplus. These are not liabilities. These are not to be reduced. Okay. And FMV2 would be calculated. See, whatever assets we are receiving, if we are receiving any bank balance, take that. If you are receiving shares and result, that means take that. If you are receiving any moved property, take that. If you are receiving any other assets, for example, you are receiving any painting, you are receiving any jewelry on account of sale, then take that. Valuation date would be the date of slum sale, would be valuation date. That would be always mentioned in a question. And at last, whenever you are doing slum sale, a chartered accountant report has to be furnished along with 44AB or just before 44AB tax audit report, certifying how net worth has been arrived and whether it has been arrived correctly or not. At last, how do we save slums? How do we save taxes on slum sale? See, this is very controversial topic. I don't like talking about this. Why, sir? Why? Try understanding this. For example, I gave you example of Mamarika. Mamarika had two divisions, B2B and B2C. B2C. Now they want to sell this unit They want to sell this unit via slum sale. Now, provision wants us to save the taxes on account of slum sale. Provision is asking us tax planning tool. Actually, how do we do tax planning? It gives us two suggestions. Two suggestions it is giving. Provision says, what should you do? Do a demerger. Demerger amounts to exempt transfer. So demerger would not arise any taxes. Arey Baba, why would we do to demerger? See, answer given by institute has been do the demerger, so it will save your taxes. Arey Baba, if I have a loss-making unit and I don't want that unit with me, what will happen if I demerge it? Still, ultimately, it will be a loss-making. If I don't want to continue in that business, business will be continued. Na? So ultimately, demerger is not a solution, but it is what it has been given by ICI. Doing a demerger would shave off the unit that you have. Second solution that it gives, the entity to whom you are selling. For example, you are selling your D2C division to HOB. For example, any of the company called HOB you are selling to. What this provision says, what the provision says, buy 100% shares of HOB. The person to whom you are selling the units now buy 100%. This will make the buyer company your 100% subsidiary, and any transfer of the asset would be exempt if you are transferring it to subsidiary company. See, if you are transferring it to 100% subsidiary, now any transfer is exempt. So it is saying that the person to whom you are selling, make it your 100% subsidiary and then transfer units. Arey Baba, if I don't want to continue business, why would I transfer it to my subsidiary? Why would I transfer? If I don't want to do this retail business, then why would I exist? Why will I transfer it to my subsidiary now? Very senseless answers they have given, but they have given, so we have to understand, we have to remember that in order to avoid the taxation in slum sale, what you can do? You can do a demerger rather than slum sale. Second thing you can do is to whoever company you are selling, buy 100% shares of that company. So any sale would be exempt because it is an exempt transfer. Any assets transferred to 100% subsidiary is exempt transfer. Second is this example. We understood two instances, slum sale and ULIP taxation. These were important in itself. We also did one question answer. Now it is 9:42 to 10:05. Take break. After break, we will continue. I always give longer breaks because the amount of knowledge that we are giving is too much, is good knowledge. So for that matter, breaks are to be good. Remember, while taking break, never ever use mobile phone. Why, sir? Because it never re-energizes you. Second thing, for longer durations, you need mental relaxation. And if using mobile phone, you are never relaxed. So try not using mobile phones during my breaks. Honestly, take breaks by listening music. If you want to listen, you can listen to stand-up comedies, but only listen, do not watch because it will not replenish your eyes or it will not re-energize your eyes. So try not using mobile phone during the break. Have a walk, listen to songs, listen to music. That would be the optimum break. Have a break. We'll meet at 10:05. 1 or 2 minutes extra you can take as per your convenience. So, guys, welcome back from break. This class started, yes, in back from break actually. So, before going to break, we started off with special cases and continuing further with the special cases only. For example, we have Anjana. Anjana bought Reliance on 1st April 2024. So, DMAT Securities is the special case. Anjana bought Reliance on 1st April at rupees 1000 one share. She bought another share of Reliance on 1st May 2024 at rupees 1200. She bought another share on 1st April 2000. So she did not buy one, but she had a physical share. She got that dematted on 1st June 2024. This share was acquired in 1990, and its cost price is 100. She bought another share on 1st July 2024 at rupees 1600 rupees. Now on 1st July, 1st August 2024, she sold one share for rupees 2000 rupees. While selling this single share, how capital gain would be computed? Full value of consideration would be 2000 rupees. It is very simple. But how cost of acquisition would be derived? Sir, whether it will be 1600, the last share price, whether it will be first share that she has acquired 1000, whether it will be 100, the old physical share, or whether it will be average as it is appearing in DMAT. Whenever you see DMAT, you see average price 1000 plus 1200 plus 100 plus 1600 divided by 4, whether it will be 975 as per weighted average method. What will be the cost of acquisition according to you? I have given four options. I have given four options for share price. What share price is going to be? Bhaskar says 1000. Bhaskar is with 1000. What others say? What others say? What's your take in this? Point is good. See, if this would have been a physical share acquired and physical share sold, simply we could have done, we could have seen the share certificate and we would have arrived at cost of acquisition. But since we have demat securities, we are not aware which security we are selling. This 2000 rupee share which is being sold can be of 1000, can be of 1600, can be this physical share also which has now been dematted, or can be the weighted average of all. Which one do we use? Which one are we are going to use? Neha says 1600. Anjana and Harish says 1000. Bhaskar says FIFO. Okay. Anybody else who want to respond to this? Sir, let's not give too much time to this topic. Simple point it is. First of all, nobody said weighted average, so let us assume weighted average is not used. Nobody said. Let me tell for more simplification, sir, last in first out is also not used. Why, sir? How do you sell the last item that you have bought? You always sell the first item. If you have 10 things in inventory, you are going to sell the first item. No, of course. First item that you had bought, you are going to sell. So it is always, it is not the first, it is not the last item. Now, important is even if we are using first in, first out, sir, whether this physical share will be sold first or whether the share that has entered into DMAT will be sold first. Right answer is always you have to go on as per the date on which it entered the DMAT account. That means if this physical share entered into DMAT account on 1st June, this is not the first share which is going to be sold. The share which entered into DMAT first is going to be sold first. Irrespective of the fact that whether it was acquired later or earlier, it is not relevant. The date on which you bought this share and this share entered into DMAT is the relevant date. Therefore, first in, first out will be made, and that too will be made based on the date on which it was entered into DMAT. I hope you got the point. 1000 is the right answer. Nobody said 100, so need not to emphasize more on this. Everybody clear with this point? Everybody clear? We have advance money forfeiture. See, what happens is whenever I buy a house, if I bought the house, if I want to buy the house, I always have to give a token money. And the token money is called advance money. In later term, if I'm not able to buy that house, that advance money, the token money that I have paid is forfeited by somebody else. Now, what would be the tax treatment of this advance money forfeited in the hands of the person who is forfeiting it? What would be the tax treatment in the buyer, in the seller's hand? Provision says the treatment depends upon when did Modi government came. If Modi government came, if forfeiture is made after 1st April 2016 or 2014, then advance money forfeited is considered as income from other sources. In advance money that has been forfeited shall be considered as income from other sources. But if it has been forfeited prior to Modi government, then in that case, what to do? It has to be reduced from cost of acquisition. Reduced from cost of acquisition. How do we reduce from cost of acquisition? Let me take one example. For example, we have with us Bhaskar. Correct me, Bhaskar, if I am pronouncing your name correctly. Otherwise, correct me. For example, Bhaskar bought a house for 1 lakh, sorry, for should say 10 lakh in 2001 and sold for 50 lakh in 2025. Vaishnav is your name, Bhaskar is your surname. Okay, Vaishnav, perfect, Vaishnav. 2025-24, he is selling the house. He received advance money on 1/10/2020 2010 for rupees 60,000. Now, what would happen? Since advance money is forfeited prior to 1st April 2011, that shall be reduced from cost of acquisition. How that calculation is made? See, full value of concession would remain same 50 lakh minus cost of acquisition. Cost of acquisition is 10 lakh now. Now, before indexation, even if indexation is applicable, we have to reduce this advance money forfeiture 60k. Take the reduced one 9.4 lakh, divide by year of acquisition, multiplied by year of sale. This is how you are going to calculate the cost of acquisition in case of advance money forfeiture. 34.122. This is how your capital gain would turn out to be. In case indexation is not applicable, simply 9.4 lakh would be the cost of acquisition and your capital gain would change in that case. But this is how you have to reduce the advance money forfeited from cost of acquisition. Sir, isn't this method wrong? Because forfeiture took place in 2010 and you are taxing it right now. You are reducing the cost of acquisition. You are reducing the indexation rate. Even if you are reducing the cost of acquisition, that means you are even reducing the indexation. Isn't this wrong? Right answer is yes, it is wrong. It is wrong. That is why it has been corrected from 2014 only now. It has been 11 years that it has corrected. It has been corrected. So okay, wrong practices were corrected in latter part, but we still have to study that because there are still some money that has been forfeited prior to 1st April 2014. Okay. Also one provision. What this says, if you are the one who is forfeiting the advance money and you are the one who is selling the house, then only advance money is to be reduced from cost of acquisition. Matlab, sir, it means, for example, if I bought the house, I forfeited the advance money. Later on, I gifted this house to one of my brother, one of my sister. And then my brother sister sells this house subsequently. Provision says in that case, I don't have to reduce this from my cost of acquisition. Getting this point? I am buying the house, I am forfeiting, and I am only selling, then only I have to reduce the advance money forfeited. But if I am buying the house, I am forfeiting the advance money and later on gifting this house to somebody else, and that person is selling the house, then advance money forfeiture would not be reduced. In the same case, for example, I forfeited the advance money and gifted this house to my sister. To my sister. And sister sold this house for 50 lakh. So in that case, full value of concession would be 50 lakh and cost of acquisition would be 10 lakh accordingly. No advance, no forfeiture has to be reduced. No forfeiture has to be reduced. Did you get this point? Advance money forfeiture. These are simple points. Another special case. Section 50 AA. Beautiful point. Beautiful point. What does this imply? Anybody having any doubt till now? Anybody having any doubt till now? Let me picturize you where we are. Where do we stand? In special cases, we understood dual taxation, we understood slum sale, we understood advance money forfeiture, we understood demand securities. I'm coming on to 50 AA. 50 AA. 50 AA talks about three securities. First one is market linked debentures. Second one is specified mutual funds. And third one is unlisted bonds and debentures. Now, what's the special feature of 50 AA's? 50 AA lays down certain assets. 50 AA lists down certain assets. And what is the beauty of these assets? You can never have long-term capital gain on these assets. These assets might be long-term because you hold them for a specified period, but these capital gain will always be short-term. This section specifically says whatever your capital asset is, whether it is long-term capital asset, whether it's short-term capital asset, we don't care. Capital gain arising on these assets will always be short-term. That means we are going to tax it as per slab or 20-15% as the case may be. We are going to tax it that way. We are not going to tax it at a lower rate. What are these assets? First of all, market linked debentures, specified mutual fund, and unlisted bonds and debentures. Oh no. Let's understand these securities one by one. For example, we have with us Neha. I am in a need of money. I said, I want money. I want money. Neha said, Arey sir, I am lending you. I am lending you money. Why to worry? I said, Neha, what you want in return? Neha said, simply market rate of interest. I said, what market rate? Neha said, 50% per annum. My eyes went this big. 50% Neha? 50% Neha? How can I give 50%? Neha said, no. If you don't want to if you don't want to pay a fixed interest, then give me some exciting interest. Exciting interest? Neha asked me this thing. I want some adventurous return. She doesn't want fixed return. She want adventurous return. Neha said, "Okay, sir, just promise me that you are going to pay me interest based on Nifty. Whatever return Nifty gives in next year, you are going to pay me 1.2 times of that return. If Nifty increases by 1% in a year, you have to pay 1.2%. If Nifty gives return 10%, I have to pay 12%. If Nifty give 100%, I have to pay 120%. If Nifty gives 50% in a year, I have to pay 60%. Whatever return that Nifty gives, I have to prepay the interest based on a Nifty return. Or it can be anything. It can be shares of Reliance. It can be shares of any company. It can be Sensex, any asset it can be. But sir, rate of interest is not fixed. Any debentures on which rate of interest is not fixed. Rather, such interest depends upon any underlying asset. And that underlying asset is any market product. It can be a share, it can be an index, it can be anything depending upon share market. Such debentures are called market linked debentures. Any capital gain arising would be short term capital gain. Okay, sir. Specified mutual fund, what does that mean? Provision says any mutual fund issued on or after 1st April 2023. 1st April 2023, any mutual fund issued whose out of the total proceeds, only 35% proceeds go to equity shares, equity market. Out of these 100 rupees that this mutual fund has, only 35% go to equity markets. Very rare now. Very rare. Out of these 100 rupees, only 35% go to equity markets. Good morning, Ujjwal. This is the time you are waking up. Very bad. Very bad. Is this the time to wake up? Sir, what specified mutual fund imply? Any mutual fund that have been issued on or after 1st April 2023. Second thing, only up to 35% goes into equity market. Rest either go to debt, rest either go to any other hedge fund, any other place it goes, but it only 35% goes to equity market. These are specified mutual fund. These are debt oriented, literally debt oriented mutual fund. These are covered under 50AA. And third, unlisted bonds or debentures. See, if you have any unlisted bonds or debentures that are either transferred, either redeemed, or either matured on or after 23rd July 2024 shall fall under this category. That means it is possible that you are given a question in which bonds are sold before 23rd July and after 23rd July. It is possible that before 23rd July they might be long term, but after 23rd July they might become short term because of 50AA. So you have to check the date for unlisted bonds and debentures. What did I just say? What did I just say? So three things I told you right now. Three things I told you. First of all, market linked debentures. Second, specified mutual fund. Third, unlisted bonds and debentures. Market linked debentures imply any debentures on which interest rate is dependent upon underlying asset. Specified mutual fund, any mutual fund issued on or after 1st April 2023. And such mutual fund invests only up to 35% of their proceeds in equity market. And third thing, any unlisted bonds and debentures which are either redeemed, matured, or transferred before after 23rd July 2024, such mutual fund or such debentures, such bonds would be considered as 50AA bonds. Any capital gain arising on them would be always short term. And also, in any of the three securities, sir, indexation is not available. No indexation. Even after 23rd July, indexation is not available on any asset. But on these assets, no indexation is available even prior to that. If you check the indexation list, I have mentioned this. 50AA securities, indexation is not available. Got this point? Arey Baba, did you get this point? Yes, sir, we got your point. We got your point. Next point. Capital gain in case of liquidation. This is a good point. This is a good point. You'll understand, you'll enjoy this point. And this normally people think is very simple, but this requires a deep understanding, deep level of understanding to understand this point. Unlisted bonds and debentures, what if before 23rd July they will be considered as long term? They might be considered long term, they might be short term if you are holding as per specified period. But after 23rd July, it will always be short term. Gain will always be short term. Capital assets might be long term, might be short term. Anjana, capital gain in case of liquidation. This is the balance sheet of Rahul Private Limited. I enjoying this point. Liquidation is something that people take it very lightly. Not covered under 50. Correct, correct, Anjana. Only bonds and debentures issued, matured, or transferred. Matured, redeemed, transferred after 23rd July will be 50. Before that, it will not be. Rahul Private Limited has a balance sheet. I am referring this. This is a very good point in liquidation. People take this point lightly. Rahul Private Limited has balance sheet where share capital is 1 crore. Reserves and surplus are 9 crore. And there is only one asset, land of 10 crore. No business, nothing. No business, nothing. Share capital has been held by only one shareholder, that is Rahul. I am the only shareholder. I am the only shareholder in this Rahul Private Limited, no other shareholder. And all of a sudden, this company goes into liquidation. This company goes into liquidation. Now, what would be the tax implication? Just to try understanding this. I had paid 1 crore rupees. Rahul paid 1 crore rupees to acquire, to build this company. Now, what he is getting in return? He might be getting land. Only asset available is land, and he has a profit of 9 crore. What would happen? As soon as this land would be given to Rahul, 10 crore land would be given to Rahul, there is a section that was going to invoke. There is a section called 222C. It specifically states that any distribution on account of liquidation would be considered as deemed dividend to the extent of accumulated profits of the company. If any company distributes any dividend on any money, any asset on account of liquidation, that shall be deemed dividend up to accumulated reserves. Up to accumulated reserves, it shall be considered as deemed dividend. That means out of this 10 crore land, it may be worth 100 crore. It may be worth 100 crore. This land might be of worth 100 crore because fair market value of land might vary from book value. So it might be worth of 100 crore. But out of this 100 crore, 9 crore would be deemed dividend. And this would be taxable for Rahul under IFOS. वो भी slab से, that will be taxable at slab. How capital gain would be computed? Just to try understanding this. Full value of consideration 100 crore. Cost of acquisition 1 crore. 99 crore is being taxed as capital gain. This is how ideal computation should be for capital gain. It is flawed one. If you are able to understand, if you are able to identify, it is a flawed computation. Why it is a flawed computation? Because out of this 100 crore of full value of consideration, 9 crore is already taxed under deemed dividend. No? So ideally our full value of consideration should be 91 only. 91 crore only should be our full value of consideration. And our capital gain should be 90 crore only. Because whatever assets we are receiving, not that assets entirely belong to capital gain. Some of the portion has already been taxed under deemed dividend. Na? So that portion of asset shall be excluded for the purpose of capital gain computation. Are you getting this point? If I am receiving 100 crore worth of land, entire 100 crore should not be my full value of consideration. Na. The portion that is already been taxed under deemed dividend, that should be removed from full value of consideration, and then remaining should be used for capital gain computation. And that is what the essence of liquidation is. If you are able to understand this thing, You have a good brain. I'm not saying oh, now topic is over. Topic is not beyond this. But if you're able to understand this, now you have a good brain. I'm telling you. You are saying, so this was easy topic. How can you say it was difficult? Arey Baba, I'm telling you, na, people are not able to understand this provision. Most oftenly, people are not able to understand. They mug up and go to exam. The applicant on case of liquidation. In the hands of company, there is no taxation implication. No taxation implication apply in case of company. But in case of shareholder, whatever the sales consideration has been received, whatever the assets that asset shareholders receive, for example, they receive land, then take FME of the land. If they receive cash, take cash. For example, in our case, 100 crore was received. Reduce the amount that has been taxable under 222C. That means amount that have been considered under deemed dividend, that has to be reduced 9 crore. 91 crore. 91 crore would be cost of acquisition. Now, full value of consideration. Reduce the cost of acquisition. That means price paid for to acquire the share 1 crore. This would give us 90 crore as capital gain. This is how taxation would take place. This is how taxation in case of liquidation takes place in the hands of the shareholder. Sir, why did government do this? There is another logic to this. There is another logic to this. Just telling you in brief. Government wanted to tax it as deemed dividend because government want to tax your reserves and surplus with slab rate only. Therefore, they made this provision. If you take out reserves from a company, ideally it is a form of dividend. So government wants to tax these reserves with slab rate only in the hands of the unit holder. Therefore, they have exclusively separated this point that if you take out any money from reserves, in any form, if you take out, it should be dividend and tax that slab, and remaining you can tax as per your provisions. Therefore, this has been separately said, whenever you receive any assets on account of liquidation, some portion has to go to deemed dividend. To the extent of profit, it would go to deemed dividend, and remaining would be considered for the purpose of capital gain. This is the taxation in case of liquidation. Clear to everybody? Are Babu log, is it clear to everybody? Is it clear to everybody? Sir, now I think you are in a position understand a next provision, that is 45.4, 45.3 and 9b. Smart point, sir. Yes. I want your full attention for next at least 40 minutes. Beautiful, beautiful point it is. I mean, the best part of income tax you will understand today. Best part of income tax. And you will understand how I have tried to simplify things for you. You will be able to value those things. Correct? If we have partnership firm and we have partners, partnership firm might give certain assets to partners, and partners also might give certain assets like land or something to the firm. It is possible either way. If partner gives to firm, provision says capital gain in the hands of partner will arise. Capital gain in the hands of partner would arise. How capital gain would be arising? For partner, full value of consideration will be amount recorded in books of firm. Minus cost of acquisition would be purchase price. This will give capital gain. And this is what section 45.3 says. Done. Done. 45.3 done. Any issue? No, sir. What did you just tease? It was nothing. What issue can we have? Okay. Let's turn the table around. Firm giving assets to partner. Ordinary course of business? Not relevant. Not relevant as of now. We'll refer this point later, but right now, not relevant. No taxation implication. Given in case of reconstitution. Reconstitution imply any kind of admission of partner, any kind of retirement, any kind of death of partner, change in PSR, anything that may happen. In this case, two provisions are invoked, 9B and 45(4). Similarly, no. If in case of, did I miss out one thing? Just give me a second. Huh? Hmm. This happens. So in case of dissolution, only 9B is applicable. Okay, this is what the basic fundamental is. When partner give any asset to the firm, taxation in the hands of the partners, whatever the value firm records would be full value of consideration for the partner, and similarly capital gain is calculated. If firm gives any asset in ordinary course of business, no taxation implication, nothing we have to do. But if firm gives assets to a partner in case of retirement, in case of death, then two sections are invoked, 9B and 45(4). But if partnership firm gives asset to the partners on account of dissolution, firm is being closed, then 9B applies. And how 9B is applied, how 45(4) is applied, I am going to take an example. Are we clear what sections are going to prevail? Now we are going to study the sections. I'm going to take an example. If you want to note it down, you can note it down, but otherwise it is okay even if you don't. We have, for example, ABR Limited, ABR, sorry, firm, where we have A, B, and Rahul, all the three partners, all of them having 2 crore worth of capital, A's cap. All of three have equal profit sharing ratio. All are having equal profit sharing ratio, 2 crore each partner has. Okay. Hmm. Assets this firm has a land acquired on 1st April 2018 for 2 crore rupees. This firm has shares, 2.5 crore, whose market value is 3.5 crore as of now. Other assets acquired for 1.5 crore, market value 2.5 crore. If you tally the balance sheet, you will find out that 6 crore is the assets, 6 crore is the liabilities. Clear point, just answer clear at every point. If you have any doubt, just ask. If you feel you are okay with everything, just write down clear continuously. This is the balance sheet of the partnership firm. Now, all of a sudden, on 1st April 2024, I had what I should say, organism. This is an organism. Okay, this organism has a multiple legs, and I had this organism in some of my wrong parts. Organism bit me, and I felt retiring. I retired. I retired from firm, and in settlement, firm gave me land. My capital was overdue 2 crore rupees. Land was appearing 2 crore in books. So its market value was 5 crore. The market value is 4 crore. My capital account was due 2 crore. Land which was appearing in books for 2 crore. This land was given in settlement of my account. Appears simple. Appears very simple. Yes. Appearing for 2 crore. This is the point where Nirmala Sitharaman ji pointed out, says there is something black in the pulses. I mean, we call it dal mein kuch kala hai. There is something wrong in this transaction. Nimotai pointed out there is something wrong in transaction. Why? He said this land would have been sold to an outsider. If this land would have been sold to an outsider, firm would have received some money. Firm would have been liable for taxes. But you are doing book adjustment just to save taxes. We are going to, for the time being, disregard. We are going to assume that if this land would have been sold to outsider, land sold to outsider, then easily full value of consideration would have been 4 crore. Cost of acquisition would have been 2 crore. But since it was acquired in 1819, then indexation was available. Let's, for the time being, indexation is index number, index number, index number, index number. Where is the index rate? For the time being, we'll assume 1819 index number is 280. Divide by such a 2 crore divided by 280 multiplied by 363. This is how our cost of acquisition would come. See, we are transferring before 23rd July, na, so we can index also. Divide by 280 into 363. 2.59 would be cost of acquisition. And our capital gain would have been 1.40 crore, 41 crore actually. Simple point, very basic point. Government is saying if you are giving it to partner, we are assuming that if you would have sold this to an outsider, that this much amount of capital gain would have been levied to you. This much amount of capital gain would have been levied to you, and you would have paid taxes at the rate of 20%, surcharge at the rate of 12%, education at the rate of 4, education cess at the rate of 4%. This much amount you would have paid. 1.41 crore. For the simplification, 1.41 crore I am taking into 20% plus 12% plus 4%. That means almost 33 lakh rupees of taxes you must have paid. Pay the tax. What government is saying, you are selling it to a, you are giving it to a partner. We will, for the time being, we will assume that you sold it to an outsider, and whatever tax that is being due, you have to pay that. Very logical it appears now. If we are giving it to partner, government is assuming that we have sold it to an outsider. So what capital gain that would have arisen by selling it to an outsider, just we have to calculate that. It seems logical. Everybody would agree with this, that it seems logical. Selling it to an outsider, this much would have been capital gain. So this much tax government is asking us to pay. Yes, it appears logical. Yes, sir, it appears logical. It simply appears logical, sir. This is nothing but section 9. This is what section 9b says. Whenever you give any asset to a partner at the time of dissolution or at the time of reconstitution, in both the cases, whenever you give any asset to a partner, assume that asset, if would have been sold to an outsider, what capital gain would arise? What PGBP would arise? Same you have to consider in your computation. Same tax you have to pay. It is very logical, very logical, that whenever you would have sold this asset to an outsider, whatever capital gain would have arisen, pay it right now as you are giving it to partner. Why to assume partner to be your family member? Assume it to be an outsider, whatever capital gain arises, just pay that. That means very simple in these terms. Very simple. Wait a second. Nemo Tai had different intentions. Let me tell you why. Nemo Tai had different intention. What did she mean? She said, Acha, each partner had a capital of 2 crore. Okay. Each partner, Rahul A had 2 crore, B had 2 crore, and Rahul had 2 crore. Each partner had 2 crore. She's saying this thing. If you would have sold this to an outsider, if you would have sold this land to an outsider, then accounting wise, not taxation wise, accounting wise, each partner would have had the total gain that you would have had is 2 crore. Of course, now 2 crore was the buying value and 4 crore is the selling value. 2 crore gain in totality firm would have had. This is the accounting gain that firm would have had. Taxation gain I'm not considering. I'm considering accounting gain. Every partner would have had 67 lakh rupees of profit. If accounting gain I'm considering, if I'm just considering accounting gain, books of value, book value, every partner would have had 67 lakh profit if this land would have been sold to an outsider. This is what accounting adjustment would have done. Now, how entry would have done, sale or whatever the cost, net benefit 67 lakh profit to each partner. Similarly, if this asset would have been sold to an outsider, then each partner was required to pay taxes. 33 lakh rupees was the taxes amount. Divide by 3. Each partner was required to pay 11 lakh of taxes. 11 lakh of taxes partners were required to pay. That means if this land were sold to an outsider, then each partner's capital would have been 2.56 crore rupees. 2.56 crore would have been land partner's capital if this property would have been sold to an outsider. Everybody who is watching live, just agree with me. If you have doubts, just argue. If you agree, then agree with me that I'm doing something very logical. I'm not doing out of nowhere. So if this land were not given to a partner and this would have been sold to an outsider, if it would have been sold to an outsider, total profit accounting gain would have been 2 crore, because if you consider the book entries, 2 crore would have been profit and that would be distributed to each partner. 11 lakh was 33 lakh was the taxes. This taxes would also be distributed to each partner, so each partner's capital would have been 2.56 crore. Each partner's capital would have been 2.56 crore if this land would have been sold to an outsider. What was 33, sir? 33 is the taxes. 33 is the taxes. If you would have sold this land to an outsider, Anjana, then 33 lakh is the taxes amount. Whatever the capital gain arising, taxes on that would be 33 lakh. Everybody who is watching live has to agree, otherwise I will not proceed. If you have doubt, you can ask. Unless you are clear up to this point, I am not going to proceed further. Unless you are clear up to this point. What did we do? I am again repeating. You are giving your land to a partner. Assume not given to partner, sold to an outsider. Simply you would have had capital gain of 1.41, taxes of 33 lakh. And your book profit would have been 67 lakh rupees each partner. And your taxes each partner would have been 11 lakh rupees. This is simple accounting adjustment that you would have had if this asset was sold to an outsider. Clear? Now what government says blows the mind. What government says? Acha, Rahul, your capital is 2.56. Okay. Your capital is 2.56. Okay. That means firm is required to pay you 2.56. Okay. How much firm is paying you? 4 crore. 4 crore? Firm is giving me a land of 4 crore, no? So my capital is due 2.56 and firm is paying me 4 crore. That means some or the other benefit that I have given to firm, I have given some benefit to the firm. That is why firm is paying me, na? Otherwise, why would firm pay me 4 crore against my 2.56 crore? Why would firm pay? It is logical that why would firm pay me 4 crore instead of 2.56 crore capital? See, if this asset would have been sold to an outsider, if this asset would have been sold to an outsider, my capital would have been due only 2.56 crore. Against that 2.56 crore capital, firm is paying me 4 crore rupees. Why this firm is paying me? Because I might have given some benefit to the firm. Firm has got some benefit from me. Therefore, this 1.44 crore is the capital gain under section 45(4). That means whenever any asset is given to a partner in case of a reconstitution, two tax implications arise. First tax implication, assuming if this land were sold to an outsider, whatever accounting adjustment take place, consider it in the books of the partner. Whatever tax implication act take place, consider in the book of the partner. Then whatever partner's capital turn out to be, take that. And in that partner's capital, check out how much amount you have repaid him. In our case, 2.56 crore was due from the partner, due to partner. In against the 2.56 crore, we are paying him 4 crore. That means firm has got some benefit from the partner. Therefore, 1.44 crore is the taxable amount in the hands of the firm under 45(4). Now, fundamental issue that you all must be agreeing that we have given this land only once. As a partnership firm, I have given this land only once, but at once we are being taxed at 1.441 crore. Second time we are being taxed at 1.44 crore. We are being taxed twice for the same transaction. We are being taxed twice. So does that mean 45.4 is illegal? Right answer is no. Yes, we are being taxed twice. It is wrong, it is incorrect, but yes, it is what it is. We are being taxed twice. Multiple representation went to finance ministry, because of which they came up with a clarification that whatever capital gain arises on 45.4, that has to be split. It has to be split. How it has to be split? Sir, it has to be split in the ratio of other assets. Assets that are left over after distribution, whatever the assets that are left over, take those assets. Whatever the remaining assets are, check the revaluation, how much revaluation is done. In case of shares, 1 crore revaluation take place. In case of other assets, 1 crore revaluation has taken place. That means revaluation ratio in shares and other assets is 1:1. This capital gain is to be split into 1:1 ratio. That means out of this 1.44 crore, 72 lakh is the capital gain that would go to shares, and 72 lakh is the capital gain that would go to other assets. And now what would this capital gain do, sir, when you will sell the shares? For example, you will sell the shares for 3.5 crore. Cost of acquisition was 2.5 crore. In this case, what would happen? 1 crore capital gain. Out of this 1 crore capital gain, 72 lakh would be reduced because it is already taxed under 45. That means your taxable capital gain later on in your life would be 28 lakh once if you sell the shares. Pen down. That was the all about 45.4 and 9b, the most simplified that you can ever see in any of the faculty's classes. This is the most simplified format. Okay, is it clear to you all? I'm briefing it down again verbally, and then we'll take another example to illustrate what it means, what it happens, how it happens. Try understanding this. If you are giving any asset to a partner on account of liquid dissolution or on account of reconstitution, two sections are invoked. In case of reconstitution, 9b and 45.4. In case of dissolution, only 9b take place. Try understanding this. Whenever firm give any asset to a partner, government wants you to assume that this asset was sold to an outsider. Compute capital gain as if this asset were sold to an outsider. This would be capital gain under 9b. Calculate taxes also, required taxes. Government wants to proceed further. Government says, assume that this asset was sold to an outsider. Then your capital would have been simply increased. Whatever the book profit that you receive will increase your capital. Whatever taxes you pay to the government would decrease your capital. All in all, your net capital would increase. And after increasing the capital, find out how much extra money you have paid to such partner beyond the required capital. In this case, our partner was required to be paid 2.56 crore. But we gave a land of 4 crore to the partner. That means partner has given something to us in return, for which we are required to pay taxes under 45.4. But sir, it is illegal, it is illogical to charge taxes twice on the same transaction, because ultimately we are giving to partners, we are giving only one land now. So once you are taxing under 9b and the other time you are taxing under 45.4, it is illegal. For that matter, what it says, what government said, whatever tax, whatever capital gain you are incurring on 45.4, what will happen to that? Provision says in that case, you have to split that capital gain into different other assets that you have in your books. Now you have to split such capital gain into different assets, and such attributed capital gain will be reduced while you sell those assets. That means other assets that we have, for example shares, when I will be selling these shares now, whatever the capital gain that has been attributed to these shares will be reduced while I will be computing shares on capital gain on these assets. This is what all about 45.4 and 9Ps. Anybody having any doubt up to this point? I know this was technical, but this is technical. It is technical. Of course, it is technical. This is not a cup of tea, not that everybody can understand. This is what the syllabus of CA final is. Oof. I enjoy this topic a lot. I literally enjoy this topic because it brings na two. I should say what I should say. I mean, it helps me to bring true of me. I mean, true person, true teacher of me, because I try to make it more simple, more simple. And in that case, most oftenly, I don't know whether you understood or not, but with upcoming example, you will be able to understand. With upcoming example, you will be able to understand everything. Just see this example. This is a standard example that you would see everywhere, in every book, in every author's book, in every example. You will see this example. I am asking you, whatever steps we did, whatever process we did, just replicate those processes in this exam. You will be able to understand everything. Mr. Prem is a partner in X and Company. X and Company has a partners. X and Company has four partners, including Mr. Prem. So X and Company has four partners, and fourth one is Mr. Prem, who share profits and losses equally. That means 25% is the profit sharing ratio of Prem. Chamka, perfect Sanket. Prem resigned from X and Company on 1st April 2024. On 1st April 2024, that means before budget, Prem retired. That means indexation would be available. On the said date, capital balance of each of the partners was 32 lakh. Okay, just before retirement, capital balance was 32 lakh. In order to settle the dues of the Prem, the firm revalued the land for the first time since purchases. The valuer also generated the self-generated goodwill. The firm has the following capital assets. Firm has a land at Pune which was acquired in 2013 for 15 lakh. Now it is valued at 50 lakh rupees. Firm also had a land at Nagpur. It was acquired for 25.4 lakh. Now it is being valued at 45 lakh. Firm also has a land in Mumbai, acquired at 88 lakh rupees, now valued at 250 lakhs. So firm has still generated goodwill. Now it is being valued at 70 lakh rupees. Okay. On 1st April 2024, X and Company gave land in Nagpur and 15 lakh rupees to Mr. Prem to settle his dues. That means against his capital of 32 lakh, he has been given land at 45 lakh worth of land and 15 lakh cash. Oh my god. First thing that you might look is, if this land would have been sold to an outsider, how much capital gain would have been due to firm? Try calculating this. See, 45 lakh is the value that would have been fetched if this land would have been sold to an outsider. Cost of acquisition of this Nagpur land is 25.4. But since this land is being sold before budget, before 23rd July, then indexation benefit is available. That means divided by 254 multiplied by 363. See, I remember the index rates, just not to get into details of that. You will be able to solve it in the same manner if you are aware about index rates. 254 divided by 254 into 363. That means 36.3 would be cost of acquisition. That means 45 minus 36.3. 8.7 lakh would be the capital gain. If this Nagpur land would have been sold to an outsider, then 88 lakh 70,000 would have been capital gain. 870 would have been capital gain. Okay. Tax on this would be 20% plus 4% education cess. That means 1,80,960 would have been the tax amount. And this is tax as per 9B. If you check this amount, you will see 189.60 is the tax amount. Beautiful. Nice, sir. Got that point. Now moving further, what government wants us to do. Again, I'm repeating that. What government wants us to do. Government want to calculate the books of accounts. Before resignation, before leaving the firm, before retirement, Prem had a capital of 32 lakh. If this land, if this land of 45 lakh would have been sold to an outsider, then 45 lakh would have been sale value, and book the profit in books of accounts would have been 45 lakh minus 25.4, because in books indexation is not given. So our profit would have been 19.6 lakh. This profit has to be distributed between the partners. 19.6 lakh, 19 lakh 60,000 divided by 4. That means Prem's capital would have appreciated by 4 lakh 90,000. Minus 189.60 is the tax amount divided by 4. This tax has to be attributed between partners. 189.60, 45, 240 is the amount of tax that has to be reduced. So Prem's capital would turn out 36,44,760. That means if this asset would have been sold to outsider, then Prem's capital would have been this. Now Prem's capital is 3644 760, and in return he's getting a land of 45 lakh plus 15 lakh cash he's getting. That means 60 lakh he's getting extra. He's getting 60 lakh rupees against the required payment of 36 lakh, which imply 23 lakh 55,240 is the extra amount that he's receiving. 2350 lakh 5 lakh 240 is the extra amount that he's receiving. And remember, this extra payment that he's receiving is not free. This will be attributed to the other assets. See, Nagpur land is given to him. The other assets that are being revalued, that means Pune land is being revalued by 35 lakh. Mumbai land is being revalued by 162 lakh. Self-generated goodwill is being revalued by 70 lakh. In the ratio of 35 is to 162 is to 70. This apportionment would take place. This capital gain would be apportioned in the ratio of 35 is to 162 is to 70 in the different lands, Pune, Mumbai, and Pune, Mumbai, and self-generated goodwill. Whenever we will be selling the Mumbai land, this capital gain would be reduced at the time of subsequent. This was all about section 45.4. Not the easiest of all, but believe me, the more number of times you listen to video, you will be able to understand. This video will be on YouTube. You can watch it multiple number of times, and I think you should watch it multiple number of times. You should watch it. This was 45.4. Clear to anybody, and clear to everybody. Any doubt to anybody? Hmm. In this topic, now I do not normally take the just faster explanation. We went slow. We tried to understand every bit of it. Anybody having any doubt in this point? Hmm. Say if any of those people who wanted to have the access of this lecture file, this is the duration of the lecture. This is how we are going to proceed. This is the size of the lecture. Every lecture contains almost 4 hours. Some contain less than 4 hours, but every lecture that we have has certain breaks. So this is inclusive of breaks. These lectures are inclusive of breaks. So ultimately in 80 hours we'll be able to do. This was the schedule of the last session. Just showing you for reference. Somebody asked me. See, till third lecture, we would continue with capital gain. I would also be solving question answers now, so it is necessary. Anybody having any doubts? Harish clear, Neha clear, other people. Anjana, Vaishnav, Kevana. Clear. Yes, sir, clear. Clear, sir. Sir, can you please share the question so that we can try of our own? वैसे तो नेहा, the question that I am saying now, just telling you for the reference. The Super 100 question that I have now, Super 100 has a question of the same frame question now, is a part of Super 100 also. Let me show it to you. See, the Super 100 is with the team on Saturday and Friday, 2 days. Typist was not working, so for that matter, it is delayed. I really feel sorry for your losses. But this question has been a part of Super 100. If you see, Mr. Prem, the question that we had will be shared to you. This PDF of Super 100 questions I will be sharing. Question number 19 is a must do practice. I will be also giving this question as DPQ, but once I have this PDF, then only I can give. Now, if I don't have PDF, how can I give? So that is the issue. Same question you can practice. Same answer you will arrive. You will be able to understand everything beautifully. Got this? Shall we move further? Shall we move ahead? Okay, sir, got it. Got it. Okay. So that completes our special cases. Now, special category of special cases. These are good ones now. These are very good ones. Now, sorry, exceptions to section 45. Now, these exceptions might not be important for Jan 26 attempt. But even if somebody wants to defer his attempt to May 26, these exceptions would be of tremendous importance. Tremendous importance. I can see in May 26 a question being asked from these questions. This topic that I'm saying. Not in Jan 26. I'm not sure about Jan 26. But in May 26 for sure a question will be asked from this topic. Now what this topic is about, let me tell you. 45.1 is nothing but the charging section. If you remember charging section was about any gain arising from the transfer of the capital asset shall be taxable under that capital gain in the year in which transfer took place. So definition of capital gain is very clear. It says that the year in which transfer took place, capital gain would be charged in that year only. But sir, there are four exceptions to that. It is not always feasible to charge tax capital gain in the year in which transfer took place. And classic of all is destruction of capital asset. For example, me and my wife, keeping hand in hand, went to Switzerland 2021. The conversation is of 2021. All of a sudden, there came a phone call that, dear Rahul sir, your house is under fire. Your house is under fire. I was crying out loud. I was crying. I was weeping my ear. I could not even sleep. I could not even wake up. I was thinking, my house gone, my house gone. In 2021, my house go, my house. I lost my house. I was crying out loud. All of a sudden, my wife told me, Arey Rahul, why are you worried? I took a fire insurance. Oh dear Lord, oh dear Lord, oh dear Lord. But it was 2024 that I received the insurance money. It was 2024 that I received the insurance money. Now, would it be logical enough to charge taxes in 2021? Would it be logical enough? Right answer is no now. If my house is destroyed in 2021, destruction amounts to transfer. Of course, destruction amounts to transfer. We studied that in definition of transfer. But will it be logical enough to charge taxes in 2021? No, sir. It is okay to charge taxes in 2024 because you received insurance money in that year. Therefore, this is the first exception where transfer took place in some other year, but tax is being charged in 2024. Now, let me give some. What should I say? Give some numbers to this question so that you are able to understand with numbers. Okay. For example, house was acquired in 2002, 3 for 40 lakh, and money I received on account of houses, the 2.5 crore. Money on destruction I received is 2.5 crore. Now, how computation would take place? First of all, full value of consideration will always be money received. Money received, or if in case money is not given to us, but a new house is given to us, then FMV of that house would be. That means in our case, 2.5 crore is the POC. See, these cases are very beautiful. You will enjoy these cases. So try participating in these cases as much as possible. I have to reduce cost of acquisition, or I should say rather transfer expenses. This will give us net consideration 2.5 crore. I have to reduce cost of acquisition from this. Now, how much cost of acquisition will it be? Sir, cost of acquisition will be, of course, 40 lakh rupees. But, sir, will this cost of acquisition be indexed? Will this cost of acquisition be indexed? Right answer is yes, sir, because transfer took place in 2021 only. Transfer took place in 2021 only. That means even if you sell it, even if you receive consideration in multiple years later, if you receive consideration in 2031 also, then to indexation would be done. Whenever you receive consideration, sir, it is not relevant. The date of transfer is relevant for the purpose of indexation. So indexation would be done. And sir, CIA of 0203. This is the CIA list. Okay. CIA 0203 was 105. So divide by 105, multiplied by. Now what should I do? 363 should I be multiplying, or should I be multiplying the year of destruction? 301. What should I be doing? Till how long I have to index? Till how long should I be indexing? Should I be indexing up to the rate of transfer, or should I be indexing up to the rate of up to the rate of consideration? How long should I be indexing? Sir, indexation is to be done only till the date of transfer. Why, sir, only rate of transfer? See, let me tell you logic behind this. Whenever you compute capital gain, correct, Vaishnav, 301. Whenever you compute capital gain, see, computation portion is to be done in that year only, 2001, 21, 22 only. Every computation is to be done in 2021, 22 only. But, sir, we have to pay taxes in the year of destruction. Taxes are to be paid in the year of destruction, but computation will take place in that year only. So, whatever provisions applicable, whatever tax rate applicable, whatever things are applicable in year of transfer, that will only apply. So, that is what makes these provision beautiful. Are you able to understand? From next year, we don't have any indexation. From next year, tax rate is 12.5%. But sir, if you have house got destroyed, if your house is destroyed in 2021 and receiving consideration 2027, even though provisions would change, tax rate would change, indexation would go, but sir, if transfer took place prior to 23rd July, you would get indexation. You would get indexation. You would also get tax. You will also have to pay tax at the rate of 20% only. Are you understanding why these provisions would make more sense when indexation is completely gone? Because you still have to study indexation even after indexation is not even applicable anywhere in syllabus. From next attempt, these will be more premium areas where examiner is going to test more, because indexation is nowhere available. But in these four cases, indexation you will see. So it will be 301. 40 divided by 105 into 301. 1.1467. That means cap gain turns out to be 135. And this would be nothing but capital gain taxable. Achha. Just asking, how much would be period of holding? Will period of holding be considered from 2002, 3 to 21? Or will it be considered from 2, 3 to 24? To which date we have to consider the period of holding? I remember what you are asking, sir. Of course, till the date of transfer only we have to check the period of holding. This is irrelevant. Okay, sir. We got your point. Beautiful, Vaishnav. Beautiful, beautiful, Vaishnav. This was simpler case. This was very simpler case. Moving on to second case. You know what? The day on which Vaishnav was born, the day on which Vaishnav was born, his father was very happy. His father was very happy. I mean, I'm just telling you the date on which Vaishnav was born. He was born in 1st May 1998. His father was very happy. And the date he was born, his father bought 10,000 square foot land in his name for 3 lakh rupees. We have got Chirag of the family. I mean, Vaishnav is the Chirag of the family. I mean, when he was born, everybody was very happy. So his father bought a land that whenever my son would be old, this land would be great help for him. He might do agriculture, he might construct hostel, he might do a in factory, whatever he wants to do, he can do. Later on, all of a sudden, Vaishnav saw spike in prices. He was so happy with his father's decision that more than the happiness of his birthday, he was more happy because he had a plot of this plot. He has this land. All of a sudden, on 1st May 2022, he feels like, Array, what should I do of this land? What should I do of this land? I don't want to keep this land. I don't want to do see. I don't want to do anything. I just want to take this land, build the houses, and sell the houses. Uh, this is the date on which he decided, and that day was 1st May, and on that day, value of this house was 2 crore rupees. He did construction work. He did beautiful construction. He did multiple buildings. He did multiple things, multiple works. He did. He drew 20 flats. Oh, 20 flats. He made 20 flats. And he spent nearly 10 lakh on each flat. 10 lakh on each flat. And it was previous year 24-25 that he sold 5 flats for, for 60 lakh each. On 1st April 2001, value of this property was, FMV of this property was actually 30 lakh. SDV was 25 lakh. Pen down. Anybody have any doubt with respect to understanding of the case, what this case is all about? Anybody having any doubt to the case? Facts of the case, everybody clear to everybody? Facts of the case is clear to everybody. Facts of the case is clear to everybody. This case is called conversion of capital asset into stock in trade. Whenever Vaishnav converts a capital asset into stock in trade, it amounts to transfer. If you remember definition of transfer, we had studied that conversion also amounts to transfer. We took the example of gold. Conversion amounts to transfer. But will it be logical enough to charge transfer into for the taxes in the year of conversion? It's just a thought now. Conversion only is a thought. Conversion does not mean that we have actually realized some money. It is only a thought now. So tax will not be charged in the year of conversion. Rather, it will be charged in the year in which actual property, actual asset is sold. And the best part is, it will be sold proportionately. It will be taxed proportionately. If you are able to sell 5 flats, only that proportion will be taxed. Now, how do we compute the capital gain? See, in this case, what happens up to the date of conversion, capital gain is implied, and after the date of conversion, the PGP is applicable. How do capital gain is calculated? For the purpose of capital gain, we have to take full value of concession, which is FMV on date of conversion. This implies FMV on the date of conversion of the property is 2 crore. Now I want your help. Transfer expenses, nothing. This will give us net consideration. This is 2 crore. We have to reduce cost of acquisition. How cost of acquisition would be arrived? Actual cost is 3 lakh. FMV is 30 lakh. Stamp duty value is 25 lakh. I want you all to calculate. I want you all to calculate cost of acquisition. I am also telling CII would be 100 multiply it by CII. We have to do till 22 23. So 22 23 CII would be 331. So it will be 331. You just have to find out the actual cost of acquisition. Index cost of acquisition. You just have to find out. Actual price is 3 lakh, FMV is 30 lakh, STV is 25 lakh, acquisition CII is 100, transfer CII is 331. What would be the index cost of acquisition? What would be index cost of acquisition? Like, can't you tell the answer? Answer na Kevina. Vaishnav says 99.3. See, whenever you consider the cost of acquisition, I have told you, you have to take actual or FME, whichever is higher. Actual or FME, whichever is higher, you have to take. But in case of immovable property, I have told you that FMV cannot exceed the SDV. FMV cannot exceed the SDV. So in that case, now your SDV would be considered as cost of acquisition. And considering this SDV, dividing by 100, multiply by 333, 331, your actual cost would be 82.75. And your cap gain would be 11.117.25. Now this capital gain is fixed in previous year 24-25. Sorry, previous year 22-23. It would not be taxed in that year. It would not be taxed in that year. It will be taxed in the year in which actual PGP is sold. Now, out of this entire building, you have created for 20 flats, and out of this 20 flats, 5 flats are being sold. Out of this 20 flats, 5 flats have been sold. That means, can I say that 25% would be taxed in previous year 24-25? That means 25% of the capital gain would be taxed in previous year 24-25 at the rate of at 25% would be taxed, and this is the amount of capital gain tax in previous year 24-25. Kevina says, please repeat when FMB to be ignored and SDV to be considered. See, Kevina, yes, I told in the morning while considering the cost of acquisition. I told in the morning cost of acquisition has to be taken as per cost or FME, whichever is higher. But what people would try to do, they will increase the FMV now. So for that matter, government has capped the FMV. Provision says if you have SDV available now, your FMV cannot be exceeding SDV. You cannot simply increase the FMV beyond SDV. Stamp duty value is the maximum FMV you can have. Stamp duty value is the maximum FMV you can have. So our FMV cannot exceed 25 lakh in our case. This is the amount of capital gain taxable in previous year 24-25. How PGP would be calculated? See, how PGP would be calculated? Let me tell you. 60 lakh into 5 flats. That means 300 lakh is being sold. 2 crore is the worth of 20 flats. 2 crore is the worth of 2 crore is the FMV of the 20 flats. Divide by 20. That means 10 lakh is the cost of each flat. Sorry. It is the 20 flat and we have to calculate for 5 flats. So 50 lakh would be cost of 5 flats. And construction cost is 10 lakh each flat. So multiplied by 5 flats, that means be 50 lakh. So our PGP would be 200 lakh. Yeah, this is not the difficult portion. Difficult portion was this only. Is it clear to everybody? Anybody having any doubt? Anybody having any doubt up to this point or up to this point or in this point? Yes, sir. Clear. Another important point. Sir, we have studied a point. We have studied a point that we can invest under bonds under section 54 EC. If you remember, if you have any capital gain on account of immovable property, long-term capital gain, you can invest that money in bonds of a company. You can invest that money. Which bonds you can invest? You can invest in the bonds of PFCL. You can invest in bonds of IRFCL. You can invest in the bonds of NHI, RECL. Even 2 more companies are added that we'll study in 54 EC. But right now, you can invest in the bonds of 4 companies. As of now, 6 companies you can invest. Important point is you have to invest in the bonds within 6 months from the date of the transfer. Now, in our case, transfer took place in previous year 22-23 only, and we have no money to invest. When should we invest the money? Provision or CBDT clarifies in this case that you can even invest into these bonds within 6 months from the date of actual sale of stock in trade. Normally, we have to invest in the bonds within 6 months from the date of transfer. But in case of conversion, you can even invest within 6 months from the date of actual sale of stock indeed. You can even sell. You can even invest within 6 months from the actual sale of stock. Got this point? That means within 6 months you can sell. How much we can sell? Arey, of course, 29 lakh this year. Baki remaining of the 50 lakh we can use the next year. I mean, 50 lakh is the maximum investment we can do now. So out of that 50 lakh, 29 would be used in this year, remaining would be invested in next year. This is how you have to consider things. Okay, third case. Okay, third case would be the last case. Fourth case we'll do tomorrow. Don't worry. Fourth case we'll do tomorrow. Are in that stage to do it tomorrow. It will be absolutely okay to do it tomorrow. Don't worry at all. Third case, what does it? What does it ask us to do? Compulsory acquisition of any property. Did I ever tell you that Adish sir has opium farms in Kerala? Did I ever tell you? He appears very clean in face of everybody, but he has opium farms in Kerala. He is teacher by just passion, by profession. He is a farmer who grows opium and sells it to normal people. You know what? He has opium farms acquired in 1998. That opium farm was acquired just for 10 lakh rupees. Just for 10 lakh rupees, he acquired opium farms. But, you know, हाँ सर कल ही बोला था. Yes, yes. You know, on 1st April 9, 2019, NRI government says, Kerala government said, we will construct a temple here. Tirupati Balaji Mandir will be created here. They compulsorily acquired this property. Compulsorily acquired this property. How much money that they gave to Adish sir? They gave only 50 lakh rupees to Adish sir. Only 50 lakh rupees to Adish sir. He was just crying out loud in the corner. He was saying that only 50 lakh. He was able to earn 5 crore from this property annually, and just getting property sold, he's got 50 lakh rupees. He's crying out loud in the corner. Literally crying out loud. He said, Judge Sahab, listen to me, Judge Sahab, listen to me. This is what government is doing, taking away all the land. He was not satisfied with the judgment. He was not satisfied with the compensation. So where did he go? He go to court. Also, this compensation was announced, but it was not even received. This compensation was received in two parts. It was received in previous year 24-25, that to 25 lakh, and previous year 25-26 he received the remaining 25 lakh. And when he went to court. He lost too many of its sandals, too many of his slippers, too many of his shoes. Just went lost. Every time, the number of rounds that he had of court after fighting for so many years, it was previous year 20 31 32. He received a compensation of 10 crore rupees from the court. And this compensation was announced in 31 32, but it was received in previous year 35 36. Until then, he also received the interest of 6 crore rupees. Oh my god. Did you understand the case of the Adish sir? Did you understand, sir? Please, can you be normal in your accent? Your accent is very weird, but it is addicting for me. I enjoy this accent. Okay. Acquired in 1998 for a 10 lakh rupees. This property was compulsorily acquired in 2019 and the compensation was decided 50 lakh rupees. But this compensation was actually paid in two parts. First part was 2004-24-25, that is 25 lakh. The other part was 25 or 26, that to 25 lakh. And court ordered the enhanced compensation in 31-32. That enhanced compensation was received in 35-36 and he was also given interest of 6 crore rupees. Understood the case. Only thing I have to tell you is FMV on 1st April 2021 was 20 lakh. Stamp duty value was 25 lakh. I have to tell you the implication of the entire transaction. Last case for the day. Entire attention. You will enjoy this point to the fullest. To the fullest, you are going to enjoy this point. But your attention is the most important thing here. Sir, first of all, there are three things to be considered. First thing is the initial payment that government wanted to pay. Government wanted to pay Adish sir only 50 lakh rupees. That is the initial compensation. Later on, Adish sir went to court and court awarded increased compensation, additional compensation, and that is called enhanced compensation. That is the second income that he got. Third thing what he got is the interest portion. So three things are to be considered: initial compensation, enhanced compensation, and interest. Three things I have to tell you. First of all, considering the initial compensation. Provision says initial compensation will be taxed in entirety in the year in which first installment is received. How much initial compensation is, sir? Initial compensation is 50 lakh. Initial compensation is the announced compensation. Initial compensation is the announced compensation, but it shall be taxable in the year in which first installment is received. So in this case, our first installment is received in previous year 24-25. Initial compensation is entire initial compensation, that means 50 lakh. Even if we receive 1 lakh rupees, the entire would be taxable in the first installment only. First installment would be only taxable. So full value of consideration would be 50 lakh rupees. Cost of acquisition. How much will be cost of acquisition? Can you tell me? Are Baba, how much? See, CII of 0102 is 100 and 1920 is nothing but, where did it go? 1920, 289. This is the CII. Can you calculate the cost of acquisition? Sir, you only calculate. Okay. See, we have to consider cost or FME, whichever is higher. Cost or FME, whichever is higher. In this case, we have SDV, but we don't have to see the SDV. Na? SDV is already very higher now, so we don't have to consider SDV. We can consider cost FM, whichever is higher. So 20 lakh will be cost of acquisition. Divide by 100 into 289. 20 divided by 100 into 289. Our cost of acquisition will be 57.8 lakh. That means in this case, we have a loss. Beautiful Vaishnav. We have a loss of 7.8 lakh. We have a loss of 7.8 lakh. Remember, we are assuming full value as 50 lakh, but received is only 25 lakh. Sir, in 25-26, 25-26, remaining 25 would be received. Does it have to do anything with the transaction? Right answer is no. It will have no implication because entire initial compensation was taxable when first installment was received. Are we clear on the initial installment? Are we clear on the initial installment? What we have to do, we have to take full value of consideration of entire initial compensation. We have to reduce the cost of acquisition or index cost of acquisition as the case may be. And third thing, sir, whenever the subsequent installments of initial compensation would be received, we have to ignore them. Now, sir, enhanced compensation. Enhanced compensation is only taxable in which it is received. Enhanced compensation is never received in installments. It is always received in entirety. Now issue here is enhanced compensation is received in previous year 35-36. So taxability would arise in previous year 35-36. Full value of consideration enhanced compensation received is 10 crore. Cost of acquisition. How much shall I take cost of acquisition? How much shall I take cost of acquisition? Sir, again 57.8 lakh. Shall I take 57.8 lakh? 942.2. This is the amount of capital gain. Is this the thing that you want me to do? Sir, you have already reduced the cost of acquisition. Why will you reduce cost of acquisition again? Right answer is yes, we don't have to reduce cost of acquisition again. Cost of acquisition is only reduced from initial compensation only. In enhanced compensation, no cost of acquisition is to be reduced. But sir, in case we have paid any litigation expenses, because in these years, for 10 years, I have to continuously pay the litigation expenses now. So if any litigation expenses are being paid, then that litigation expenses can be reduced. This will give us the capital gain amount. Beautiful, Harish. Sir, will this capital gain be long-term capital gain or will it be short-term capital gain? Sir, it completely depends upon initial compensation. If initial compensation's capital gain was long-term capital gain, so this will be long-term. If it was short-term capital gain, it will be short-term. Third component. Sir, interest component. Sir, we received interest amount. We received interest of 6 crore. Provision says interest is taxable in the year of receipt. In whatever year interest is received, you have to consider that and you get a deduction of 50%. See, this interest is taxable at IFOS and you get a reduction at the rate of 50%. That means only 3 crore interest is taxable in your hands. Also, sir, sometimes what happens is, I'm telling you a very, very deep case. Adish sir went to court. Adish sir, I mean, initial compensation was announced, even though not received, but initial compensation was announced. Adish sir went to court. As soon as Adish sir went to court, now court knew that sooner or later it had to award certain compensation to Adish sir. Court already knew this thing. So instead of waiting for the final order, court asked the government to pay 1 crore rupees as enhanced compensation because of interim order. Court passed an interim order, that means in between order, that paid 1 crore rupees to Adisha, because we are already aware that some or sooner or later you have to pay certain compensation. Court is saying to government that sooner or later you have to pay the compensation, pay at least 1 crore right now. This is the enhanced compensation based on interim order. Is it possible? Yes, it is possible now. If court is already aware that sooner or later government has to pay enhanced compensation, court can ask the government to pay at least some enhanced compensation based on interim order. Later on, remaining enhanced compensation will be given at the time of final order. It is possible that court may award enhanced compensation based on interim order. Provision says ignore that. Always ignore that. Whenever any enhanced compensation is received on account of interim order, it is always ignored. Higher enhanced compensation will only be taxable at the time of final order and when it is received. Are we clear? Are we clear with this point? 2 to 3 important pointers I want to tell. Any compensation received on account of right to fair compensation, transparency, land acquisition, rehabilitation, resettlement act is exempt. Right to fair compensation, transparency, land acquisition, rehabilitation, resettlement act is exempt. Sir, you have to ignore the name. You just have to remember that there is a big act that is being referred. Any compensation received is exempt. Second thing, if you have urban agriculture land, that is compulsorily acquired. You are individual and HUF. You used it for 2 years. Compensation is paid by RBI. This is also exempt under section 1037. If you have any urban agricultural land that has been used by you and it has been compulsorily acquired by government and compensation is paid by RBI. See, if nothing is mentioned in the question, you have to assume that compensation has been paid by RBI. Otherwise, everything will be mentioned that it is urban agricultural land, it has been compulsory acquired, it has been used, it has been owned by individual HO. Everything will be mentioned. But if it is not mentioned that compensation has been paid by RBI, you have to assume that compensation has been paid by RBI only. It is exempt under 1037. There came a case in this provision only. What happened was, for example, we have Harish. There came a case. What this case was all about, let me tell you. Harish is an individual who has the urban agriculture land, which land he has been using for at least 10 years. That land was compulsorily acquired by government. Compensation announced by government was 1 crore. Should this property be exempt? Right answer is yes. Property should be exempt. Property should be exempt. Correct. Property should be exempt. But all of a sudden, Harish felt like, yeah, 1 crore is not enough. 1 crore is not enough. But instead of going to court to increase this in compensation, he did not go to court. He went to district collector. He went to district collector just to get his compensation increased. Assessing officer said, Harish, you are okay with the sale. You are not arguing. You're okay with the sale. That means this should not be exempt because you are not actually selling. You are actually not giving your land. Your land is not acquired. You are actually selling this land, so it should not be exempt. Are you understanding to what levels of Bewakufi assessing officer goes? To what levels of to heights of stupidity the assessing officer goes? This is a high court judgment that even if your property has been compulsorily acquired and you do not object to it, it does not mean that you are voluntarily selling it. Property acquired and I'm not objecting, I'm just going to collector. That does not mean that I'm voluntarily selling it. Assessing officer treated as a voluntary sale and revoked the exemption. Are you understanding? Sir, sir, it may happen, na? It may happen somebody whose property has been acquired today and the date on which he received compensation is maybe 10 or 12 years later. During this period, somebody may be alive, may not be alive. Maybe his legal hire would take the business. In that case, this income would be taxable in the hands of the legal hire. Legal hires have to pay the taxes who are receiving the enhanced compensation. Let me see. Did I miss out anything? Otherwise, this topic is also over. See, whatever I told you, everything is written here. If you want to take a screenshot of it, this would be of immense help. Whatever I told you, everything is written as it is in this book. Everything as it is written. It does. Okay, perfect. This also covered. This also covered. Okay, perfect. Absolutely, everything is covered. One thing I missed out, sir. In case, for example, court decreases the compensation. For example, government announced the compensation of 5 crore, but court thinks that government has paid more compensation. Can court decrease it? Right answer is yes. Court can decrease it. Normally, it doesn't, but court can decrease it. Second thing, if court decreases it, then assessing officer has to do a rectification order. He has to recompute the income of the assessee by reducing the amount of capital gain. Because that's it. I guess that's it. That's enough for today. Tomorrow we'll be doing joint development agreement and the other exemptions, tax rates, and exempt transfer. Tomorrow we'll be able to end this chapter well. So, anybody having any doubt till now? Anybody having any doubt till now? See, since morning, how much we did, let me picturize it for you. Let me picturize it for you. You will enjoy. This session has been really power packed for me, and too much of knowledge outflow has been done today, and too much of knowledge inflow for you all also. So hats off to your efforts. We started off with cost of acquisition. These cost of acquisition cases are in itself technical. Then we came on to indexation and first proviso. These also were technical. We came on to slum sale. We did tulip taxation, 50 double A, liquidation, advance money for which are demat securities. We also did 45(4), which was not easy in itself. Then we came on to destruction of capital asset, conversion, compulsory acquisition, and we were left with joint development agreement. This we'll do tomorrow, I guess. It will also take 10 to 15 minutes. I don't think that is the time you want to do. Tomorrow, after that, we will start with exemption. That would take only half an hour. We would do tax rates 1 hour. Exempt transfer, that would also take 1 hour. And then we'll do question answers. So need not try. And we are going at a very good pace. I have the planner with you all. You can see the planner, and you will find out that we are almost at a very good pace. If you see the timelines, you can also find out that in previous batch also we did this much classes only. The classes you might see in your batch might be longer because For your classes includes break also now. So for that matter, breaks have been excluded from these classes. In some of the classes, breaks have been included, some not does not include. So classes are almost there. We are going at a good pace. We are understanding provision to the fullest. We are giving too much time to the provisions, and we are also giving time to the question answers. We will be giving time to question answers. So it is great that you are enjoying these sessions. If you have any doubt now, do let me know. Let me know in the comment box. Let me know on my Telegram channel, on my personal number. You can ask any doubts, any number of doubts that you want. If you have not considered enrolling for this batch, do consider enrolling for it. If you have not, share it with your friends. Do share it. I enjoy teaching people life, and even students enjoy studying life. If you have anybody who wants to study for this batch, who wants to study with me, he is always welcome. She is always welcome. Even till 11th or 12th lecture, I'm saying now he can join it. He can join the batch till 12th lecture also. So if you want to study DT, you can join live. You should join live. Even if you are watching this lecture recorded and a recording is not 10 years back, not 10 days back, then you can come for the next lecture live. It would be great to study live things. So, guys, that's all from my side. How was your experience at this second session? Do let me know in the comment section after the batch is over, after the session is over, so that more people who are watching this lecture are aware about the classes, how classes are taking. That's it from my side. Bye bye. Take care and enjoy studying. See you guys tomorrow with same energy, excitement, and enthusiasm, and that too at the same time.